Ladies and gentlemen, welcome to today's session with Chris Capre, former hedge fund trader. We're going to be starting in about 8-9 minutes, guys. So go ahead and get ready. Pen and paper, guys. We have a great session planned for you today. Go ahead in the chat. Let us know what stocks you're trading. Let us know what you're looking at in the markets as well. Chris is going to go over that. He's going to read it as well. And we're going to have a great session here for you guys. We'll see you in a bit here. What's up, everybody? Are we ready to start? Let me know in the chat whenever you guys are ready to start. Until you guys are ready and you let me know, we are going to get this started. In the meantime, guys, go ahead, put your tickers in the chat. Let me know what you're looking at in the markets. Again, Chris Capre will be going over a lot of things today here. We have a great session. It's the first week of the Benzinga Option School. We're very proud here to have this for you guys. And okay, it looks like a couple folks here are ready to start. Let's see. Chris is ready. Raymond is ready. Okay. Ronald, we're good to go. Jocelyn, we're good. Jasmine, Pat, Howard, Lane, Mark, Alex. All right. People in the YouTube chat are pumped. They're ready to go. All right, guys. We are going to start this now. Let me just get this timer out of the way. And I think Chris Capre is there in the building here, right? Chris,
in the house.
how are we? Wait, we got Chris here, guys. We're good to go. How are we doing?
Very good. And yourself?
I'm doing great, man. It was a great day. I had a really nice trade today on a firm. I just catched a little dip there, but you're going to go over so many things here that I know everybody's pumped and excited, Chris. And in the chat, let us know as well where you guys are tuning in from. We always want to know where our base is from, and always global, but good to see you guys checking in, right? So, Chris, you have an amazing session ready, right? So let me know when you can take over the screen here and we can start with the presentation.
I'm all good to go. I'm gonna, let's see here, take over screen and give me a second here. There we go. Okay, I should have control there.
Looks like we got people from all over here, Chris, but you'll take over there and everybody's pumped here and excited. So let's go, guys.
Great. And then let me also put up some video. There we go. All right, put a 1 in the Zoom chat if you can see my webcam. Very nice. Put a 2. It seems like y'all can hear me fine. That's good to hear. Awesome, awesome. San Roan, California. Iceland. Wow, must be late your time. You're probably, what, 7 hours ahead of us? 7 hours. I'm in California here. Well, I'm not in California. I'm actually on West Coast now. I'm in Lake Tahoe. I'm on the Nevada side. So I'm going to put in Lake Tahoe, NV side. I'm actually not far from the CEO of the stock or the company Mara, the Bitcoin mining company. So he's not too far from me, actually.
Interesting. Chris, I'm pretty familiar with your background, but for those guys that are, new for the first time, if you don't mind, just, a quick introduction of your background experience and, everything there in between. I know you have quite thick background there on Wall Street.
Sure. Okay. So let's have that on the first slide here. So I've been trading 21 years professionally. I am a former broker on Wall Street. And so I was an FX broker. Our offices were on 32 Old Slip, and 32 literally intersects to Wall Street. So I literally walked Wall Street every single day to work. That was in 2004, 2006. I was a broker. I helped them also move from the New York office to the San Francisco office, helping them open that up. After that, I got a job trading for a hedge fund. It's called the JNF Hedge Fund. And so I was a trader for them while I was with both the brokerage and the hedge fund, even though I didn't, ask for the job or anything like that. They both had asked me to also teach classes for their, employees as well. And so I did that at the brokerage and I did at the hedge fund. They said, hey, we got new trainees. Do you want to help teach them as well? I said, sure, no problem. So I've been teaching, people how to trade for about 17 years now. And I've been trading 21 years professionally. So I do have institutional retail experience. I have hedge fund experience. I've been on the inside of the market as a broker. And that kind of has afforded me a certain insight into the markets that you're just not going to see from, I guess a lot of the YouTube stars and stuff like that today and stuff like that. So I'm also a verified profitable trader. We shared our results for 2020. We're just composing all them now for an article we're going to put on 2021, how we did. Verified profitable trader, did about 72% return in 2020. About 63% accuracy. I haven't gone over all the stats yet for 2021. We're about 58.5% accuracy, and we made money again. Again, I haven't gone 100% gains yet, but we'll share all that on our website soon. So you know that I make money trading. So with that being said, just want to say hello to everybody in the Zoom webinar here. Good to see everybody here. There's also people in the YouTube as well. And so combined with that, we got a lot of people here. I know there is a little bit of a delay between the live Zoom stream and YouTube. So I will, do what I can to incorporate both of you and answer questions from both. I will be looking at both all the time. So that's pretty much my background. Are you down with me getting into the rest of the presentation, Rodrigo?
Yeah, let's go ahead, man. I'm excited.
Okay. All right. So with that being said, I just want to say there's people posting in chat on Zoom, and then there's people posting in the Q&A. For those of you posting in the Q&A, please post in the chat. It means I have less windows to open. So everything that you post in the Q&A, just go ahead and delete it and repost in the chat. So I just have one place to look for all that. That would be appreciated. Okay, so let me just get that going, and I am ready to start the presentation. So today's presentation is on Intro to Option Trading Principles. And that may sound like, hey, this is an intro to options, presentation in full. And part of that's true and part of it's not. This is about option trading principles. And as someone who is a broker on Wall Street and someone who's worked for a hedge fund, traded for a hedge fund, I come from this very kind of core belief and core experience, which is that regardless of whether you and everybody else in here is a technical trader, a fundamental trader, a sentiment trader, a flow-based trader, we all come together on one point. We all become one common variable. When we make buying and selling orders, we all become a common variable, and that is order flow. We all have to make buying and selling decisions. And it doesn't really matter if we make the buying and selling decisions for technical reasons or fundamental reasons or sentiment reasons or flow-based reasons. The bottom line is all those reasons eventually get collated into one thing: buying and selling orders. And it is the total collection and collaboration and communication of all those orders that is what moves price. It's what moves the price you see on the charts. Some people say price is emotional. That's true for humans, but there's a lot of order flow that's not emotional. That's completely algorithmic. That is completely mechanistic. We're going to talk about that order flow, particularly with the options market, particularly dealers and market makers. But it's important to understand that that total summation and collection of order flow is what causes all the price fluctuations you see in your charts. That's the most proximate driver of price action, is that order flow. And so from that belief, it is from that approach to the markets that I trade everything. That's how I trade everything. So my job as a trader is to understand that order flow. As an options trader, we have a certain advantage. So in a stock market, you can, if you're just trading, buying and selling shares of stock, you get access to some of that information in the order flow. You can see, in the time in sales, the size of the shares being traded at a particular price at a particular time. You don't know if they're long or short. We don't know if they're opening or closing transactions, but we can get an idea of certain patterns of flow there. So there is some information in order flow there. We can look at the level 2. We can look at the ladder and kind of see where liquidity is lining up. Are the bids overweighing the ask? The offers? Are we kind of seeing, laddering up of trades or laddering down? We can see some of that order flow, but then again, there's not a purely mechanistic expression of that order flow. Options is unique in the sense that we can see not only through the volume of the order flow at a particular stock, at a particular strike for a particular expiry, we can also see the open interest. And so volume simply represents the number of option contracts traded on that stock, on that strike for that expiry. The open interest tells us how many contracts are still unsettled in the options market at that stock, at that price, at that strike. This gives us information about that overall order flow. Where is it strong? Where is it weak? Where is liquidity really pulling around? Where is it moved away from? That gives us an advantage. And on top of it, there is a mechanistic version to order flow that we're going to talk about later in this presentation. So as an order flow trader, options really give me, and they give you, once you learn to read the tea leaves of option order flow, of where potential support and resistance is. Is the market rallying because traders are getting bullish, or is it more of a short covering rally? Is volatility expanding or contracting? Is, liquidity coming into the market, or is it coming out of the market? That is all very important information for us as traders. And that's one of the reasons why you want to learn options, because as you learn options, you'll be able to see and spot those pieces of information. And that gives you trade ideas. That gives you an edge. Now, with that being said, how many people in here are trading only stocks? If you're trading only stocks, put a 1 in the chat. If you're trading stocks and options, put a 2 in the chat. So 1 in the chat if you're only trading stocks, put a 2 if you're trading stocks and options. Somebody put a 3 in there for options only. Very clever. Nicely done.
See lots of 1s there, Chris.
Lots of 1s, fair amount of 2s. Okay, good. And some 3s. Okay, great. So 1 is if you're only trading stock. 2 is if you are trading options, and 3 is if you're trading stocks and options. Oh, futures is 3. Okay. All right, we're changing the parameters. All right, copy that. Okay, so with that being said, sorry if you hear some noise in the background, my dogs and cats are fighting. It's quite entertaining. Not really if you're the cat or dog, but it's still entertaining to me. Okay, so with that being said, for those of you who are trading stocks only, I just want to give you a brief description of the many more ways that you can make money trading options that you cannot make if you're just buying and selling stocks. So, for example, if you are buying and selling Apple, you really only have a binary way of making money trading Apple shares. You buy it, it needs to go up in price. If it doesn't, you lose money. If it goes up, you make money. Very binary, that's it. Yes, you can make money if Apple has a dividend, but if you were to look at your total P&L at the end of the year, let's say you made $500,000 last year, I'm willing to bet that less than 10% of your total profits are dividends. What that means is that the majority of the ways that you make money trading stocks is simply buying and selling the stocks and being right more often than not. That is very binary. You either make money if it goes up, you lose money if it goes down. You can take the other side of that and say, hey, I think it's going to go down. You sell it. If it goes down, you make money. If it goes up, you lose money. Very binary. There's only so many ways you can make money doing that. With options, you can make money if the stock goes up. You can make money if the stock goes down. You can also make money if the stock, maybe you don't know whether it's going to go up or down, but you think it will go up or down. You can make money on both directions at the same time. So you can bet on both directions. If I buy shares in Apple stock, it has to go up for me to make money. If it does that, I make money. If it goes down, I lose money. Okay? That's binary. But with options, I can make money if it goes up. I can make money if it goes down. I can also say, you know what? I don't know if it's going to go up or down, but I think it will go up or down. You can make money on both of those plays in one trade. You can also make money if it goes nowhere. If you buy Apple stock and it goes absolutely nowhere, you don't make any money. You've committed your capital and margin to buy shares. That money isn't making you $1. With options, you can make money if the stock goes nowhere. So just on direction alone, you can make money more ways with options than you can with stocks. That should pique your interest, because the more ways you can make money in the market, the more ways you can create an income for yourself. The more ways you can build up your trading account. Just like in a business, if you only have one product to sell versus multiple products and verticals and technologies and things like that, the more ways your business can make money, the better. Same for trading. But that's not the only way you can make money. You can also make money via time. Just the passing of time and you can make money. The stock could absolutely go nowhere, but just because one day passes and another day passes and another day passes and another day passes, you can make more and more money. So now you have another avenue, another way to make money and create an income for yourself trading. But that's not all. There's even more. You can make money via volatility. Now, if I buy Apple shares, let's say I buy Apple shares at 150, it's at 150 right now. And let's say I have a price target of 160. If Apple goes from 150 to 160, whether it happens in one day or 1 week, it's still the same amount of profit. It doesn't matter how fast it got there. It's still the exact same amount of profit. But with options, you can actually make money if the volatility increases, or you can make money if the volatility decreases. Again, another way you can make money that you cannot make with stocks. Not about you, but if I have a business where I only have 2 ways to make money, or I have a business where I have like 5 ways to make money, I generally want to have that business where I have 5 ways to make money. You can actually make money just on volatility alone. You can make money on the expansion of volatility or the contraction of volatility. That is a powerful way to make money. There are some option traders who just make money trading volatility. That is something to think about. Options also gives you an opportunity to hedge that stocks don't. If I buy Apple at 150 a share and it's at 160, I'm up $10 per share. So let's say I have 1,000 shares. 1,000 shares times $10. I'm up 1,000. I'm up 10,000 in profit. Okay. So I have 10K in profit right now. What if I still want to stay long Apple, but I feel like Apple's hitting resistance and it's going to go sideways, or maybe it's going to pull back a little bit, and I don't want to get out of my Apple position at 150. I like being long at 150. I like this price. Maybe it pulls back $1 or $2. Not a big deal to me. I want to hold it because I think it's going to 170, 180, 200. Well, the problem is if I'm long shares, I have to eat these losses while it pulls back. But with options, I can make money, even though my stock position is losing money, I can make money while this is pulling back. And so if I'm making money with options and I'm losing a little bit of my stock position, that's a way to hedge. It's a way to either offset risk or hedge. So it's important that we all understand that options give us a way to hedge our position, to neutralize risk in ways that just buying and selling stocks doesn't. So it's another way our business can make money. Very, very important. And then the last method is repricing of risk. So if the S&P is like in an uptrend like this, buying downside protection in case maybe you're long the S&P, let's just say at 400. And now the S&P SPY is at 450. Now, if you want to buy downside protection, which would be buying long puts or various other hedging strategies, it's going to be cheap at 450. But if SPY pulls back to say 440, that same downside protection is going to be more expensive. It's more expensive because SPYs is pulling back and downside protection is more expensive. It's cheaper when it's going up. It's more expensive when it's going down. So how does this work out with options? It means that just by the repricing of risk, the downside protection, you can make money and you don't even have to be right on the direction. SPYs could go sideways at 450, but because there's an increasing risk of a downside move, those puts, which is if you go long puts, that's buying protection to the downside. If those puts get more expensive in price, that's a repricing of risk. So you don't even have to get the direction right. As long as the risk is repriced, you can make money via that way. So, and sometimes you can combine all of this into one trade, meaning you can make money on the direction, a pullback going down. You can make money on time. You can make money on the volatility increasing. You can make money because you hedge your long stock position and the risk is repriced. You now have 4 or 5 ways that you can make money in trade. That with stocks, you only have one. If you think about that, that should very clearly communicate something to you. It should communicate, wow, I might want to learn this because right now I only have 1, maybe 2 ways to make money. But with options, I have a whole playbook of ways to make money that I cannot make with stocks. Does that make sense? Yes, no? Put a 1 in the chat if that makes sense. Put a 2 if it does not. And if you do put a 2, let me know what doesn't make sense about it. Lumos is saying you just blew my mind. Glad to hear. Lavage de Vitres Boudry saying awesome day in the option school. I'm glad to hear it. Lavage, are you in Montreal? I'm just asking because I lived in Montreal for 2 years, so I do speak a little bit of Canadian French still. Okay. Let's see here. The repricing of risk. Yes. Okay. Thank you for asking that question, Darley. So the repricing of risk, options as contracts, they have a mechanism, various mechanisms or variables that affects the cost of those options. One of the things that affects the cost of those options is the level of risk in the market. And so if the options market starts pricing in more risk into the market, those puts, that downside protection, those option contracts that make money if the stock or index goes down, those things gain in value just by being repriced. So it's very easy for something to get repriced. Think about it like this. If you live, I lived in California for many years. As you all probably watched in the news, California often has fires. But there's also certain years where California doesn't have that many fires. If I go to buy fire insurance and there hasn't been a fire in my area for 10 years, that fire insurance is pretty low because the insurance company's like, there's not much risk of you having a fire. You're not near a forest. You don't have a lot of trees on your property. Hasn't been a fire there in 10 years. The insurance company's gonna be like, we'll give you that fire insurance for cheap. Now, if I go to that same insurance company, but there's been a fire yesterday in my area and I have a lot of trees around my area, that's a repricing of risk. There's more risk involved in giving me fire insurance than, say, the person who hasn't had a fire there in 10 years. So that's a repricing of risk. The same works in the option market. For people who want to buy long puts, these are contracts that make money if the stock or index goes down. Those puts can get repriced as more expensive if the risk level goes up in the market. So it's super important to understand that. Does that make sense? Who was the one who asked that question? I am trying to scroll through and I can't find it. But whoever asked that question, hopefully it makes sense. Okay. Just moving through. There's a lot of chat. Oh, it was Darlise Floyd. Okay. You are in Montreal. Okay. I used to live in Plateau area there, so not too far off Avenue de Montreal. Yeah. Number 5 really confused me. Okay, Guillermo Lopez, let me know if that re-explanation makes sense. Just because I'm in Canada, it does not seem to be the same. Okay. Can you explain the concept? So for those of you that asked for me to explain the repricing risk, let me know if that is. Eduardo Ortiz is saying, is this actually live? Apple is at 170. Yes, it's live. I'm just using a random quote. We'll go over some live charts later. Okay. All right. Chris Gaskins has a question. Would a put ever gain in value if the underlying asset is just sideways? Yes, possibly before earnings. Before earnings reports, potential increase in pricing or risk there for sure. Okay. We're going to get Avinash. We're going to get into what is a put shortly. Stefan said, can you give an example with an option price? We will get into that shortly. Don't volatility and risk repricing translate to the same thing in dollars? No. Volatility is an ever dynamic variable. So, and it's not a fixed repricing per se, because it's volatility will influence price, but so does moneyness, so does time to expiration, so does the level of implied volatility. So all these variables are dynamic. When you say long, is there a specific amount of time they usually attribute to that? No. When I say long put or long call, I am just saying, hey, I own those calls or I own those puts. Being in Montreal, also, I do have a question. Is it normal that returns are not the same in Canada for the same contract, same expiry? No, especially if you're trading with a US broker, it's the same. Okay. All right. So around how to trade options with a budget, we'll get into that in a little bit. Can you talk about order flow? We get to that later in the presentation. We'll be explaining open interest and how that affects where the stock may close on expiration due to strike with high open interest. If we have time to cover that, that's in the section on option order flows. So yeah, if we have time to cover that. Will this be recording sent out? It'll be saved on YouTube, so you won't have to worry about that. Okay. Checking with my YouTube people real quick. I love the term playbook. I appreciate that. Matthew Lewis says, makes you want to sell all my stocks and just do options. I know I kind of had the same experience when I started, really learning about options. Yeah. Would you please go over time decay? If we have time, we do have some things we want to focus on, but if we have time. Okay. All right. Let's get into the first part of what it is you need to trade options properly. I want to give you a kind of framework and roadmap, so to say, so that you feel like, okay, if I want to learn to trade options, what is, a relative path? What does the scaffolding look like in each step that I have to take along the way? There's a lot of steps, but I've simplified them into 5 simple steps. So if you want to trade options, there are 5 general steps that you have to take. And I've put this in order so that you build these skills in order. If you build the skills in the wrong order, it's kind of like building a house. Like, okay, you build the foundation, but then you go to the second floor. You wouldn't do that. You start from the ground and work your way up. You work with the most important base foundation that you need, and then you slowly stack on top of that. That's how you need to learn options correctly. If you learn it out of order, you'll have skills that won't match with where you're at. You'll be learning things that are too advanced or learning things that are too easy. That's why it's important to learn things in the proper order. Just like if you go to get your black belt or you start in martial arts, you don't learn the toughest kicks on day one. You learn footwork, positioning, proper posture and things like that, breathing. Those are base skills and you work your way up. So it's important that I give you this framework, so to say. Okay. All right. So the first step in understanding options properly is to really understand the option mechanics. How does the option market work? We're going to get into the basic mechanics of that, calls and puts. I have a whole slide on this, and we'll take a few minutes to kind of explain how the options market works for those of you that are new. For those of you that understand this, I'm not saying you can zone out. I'd say keep listening in because there might be something I say in there that you've never thought about or heard of before. I often listen to the same information about things I've learned before because sometimes I learn something new each time. So it's important to understand that. Okay. Just checking in. Okay. And with that being said, it's also important to understand that this framework that I'm giving you is a simplified version of the framework. Sorry, my dog's barking and there's probably somebody at the door. He likes to let us know when somebody's at the door. Oh, that's funny. I wish I could get a mute button for my dog. It'd be awesome. All right. So with that being said, this framework and path I'm giving you is the same. It's the simplified version of what we teach in the Benzinga Option School. So I'm kind of teaching you like little pieces from the Benzinga Option School and how we do it. So the first part is understanding option mechanics. How does the option market work? What is the basic building blocks, which are calls and puts? What does it mean in terms of strike and expiration, all these things? That's option mechanics. If you don't understand how that works, you cannot progress to the next level. There's no point in learning more about options until you learn that, because if you don't learn how that works completely and you understand, not just understand it, but you can totally apply it, then it's important that you don't skip these steps, because if you do, you will have holes in your foundation. And if you try and learn more advanced stuff, you won't be able to understand it completely because you missed the foundation. This is the foundation. The second thing is the understanding option Greeks. we're going to get into this. We'll have a brief lesson on option Greeks today, but option Greeks is, think of these as variables that affect options pricing. So a comparative example I used today in the live Benzinga option school class was option Greeks are these variables that affects pricing, just like I myself ski and snowboard. There are variable conditions that affect my skiing and snowboarding experience. For example, weather is one of them. Is it sunny? Is it warm? Is it cold? Is it windy? If it's cold, the snow is probably drier, or it could be a little bit icier. That's going to affect the condition of my skiing and snowboarding experience on the mountain. However, maybe it's moist. That makes the snow slushier. So that's going to slow me down a little bit. Again, these are all variables that affect the same thing, how I'm skiing and snowboarding that day. The Greeks are very much like that. They're all these little variables that can really affect the pricing and the opportunities and whether it's a good option or a bad option. You may have the right direction to trade a particular stock, but the option may be overpriced. And so you're overpaying for something, and that may come back to hurt you. That's why you got to understand these Greeks, because if you don't, you won't know whether they are saying, hey, this is expensive or this is cheap. If it's cheap, there's an opportunity there. If there's expensive, it's probably not the best opportunity. You may want to look for other ones. That's why it's important to understand these Greeks, because they teach you these kind of ski weather conditions that I was talking about. They tell you what to be expecting and how to examine it. Does that make sense? Maybe my dog wants to trade options. I bet he would, especially if he can get him food. That's funny. Okay. All right, just checking in. Okay. All right, great. Seems like everybody's getting that. All right. Third step in your process of learning options. Again, I'm trying to give you this roadmap. At this point, you have a solid foundation to start learning option strategies. I will teach you a very basic strategy today, but at this point, it's time to learn some of the strategies in the market. You have enough knowledge, you have enough skills, you understand how these variable snow conditions affect your skiing, snowboarding experience. You understand how the options market works. You understand how these variables work. Now it's time to learn very specific strategies to attack the markets. But the problem is that the good thing about options, this is the great thing about options. Pretty much all of the option strategies out there are known. This is not the hard part about trading options. The same option strategies that you use, I'm going to be using. And so, you know, a long call strategy is the same strategy for me as it is for you. There's not like, hey, some secret indicator and some Da Vinci Code statistics, and you need to combine this with this pattern and things like that. They're all the same strategies. That's the great thing about the options market. The problem with that is, and it's not really a problem, but the challenge is knowing when to use the right strategy at the right time with the right pattern on the chart. And that is where you start to pair your strategies with the price action and order flow. But before you can do that, you have to learn each of these strategies. Think of them like tools in your toolbox. Like I have this little toolbox and it has a hammer and nail and a leveler and all these different things. I have to know what each one's for. If I don't know what each one's for and how it works and what it's good for and what it's not good for, I'm going to use it at the wrong place and the wrong time. That's how options work. So you first have to learn the strategies. After you learn all the strategies and how they function as a whole, then we find out, okay, you know how it works, what it's good for, what it's not good for. Now I'm going to teach you the exact patterns you want to apply this to and which ones you do not. So it's super important that you learn that skill. Now, after you've learned all these skills, the hardest skill is next. And that is learning about dealer and hedging flows. We are going to have a lesson on this today. We have a few slides on this today that we'll talk about. But this is one of the great benefits of the options market, is that there is a certain mechanistic activity in the options market. There's a certain reflexivity. So a reflex is if I blow in my dog's eyes like some air, he's going to blink. That's a blinking reflex. It's something that's kind of done automatically in response to a stimuli. The options market, particularly the dealers and option market makers, they have very reflexive actions too that we know with a certain, for example, option dealers and market makers, they have a role to really fulfill in the market where they provide liquidity, take liquidity, they offset positions, they take positions. So if I buy 100 SPY calls, they're on the other side of that. I'm long 100 SPY calls. They take the other side of that. They're short 100 SPY calls. So that part's not really reflexive. It is, we know they're short SPY calls. But if I'm a dealer or market maker, I don't want my profit model to be whether the market goes up or down. Why? Because if I can just offset positions and provide liquidity and bring buyers and sellers together like a broker does, or if I can offset and hedge internally, then I'm going to do that because I can collect the spread and do that. So how is this reflexive for them? I buy 100 calls, they're short 100 calls. That means that if the market goes up, their short calls start to lose money. They don't want that. So the moment I buy these 100 calls and they're short 100 calls, they're going to instantly algorithmically hedge that position. It's called a delta hedge. And they're going to do that by getting long shares or long futures. So now if it does go up, their short calls lose money, but their long stock or long futures make money, and it offsets each other. That's what they do automatically, algorithmically. And it's done millions of times a day. On top of it, as that position evolves, they will either further increase their hedging exposure or decrease it. They will get more stock, or they'll reduce their long stock holdings. That is reflexive. And we can glean that, and we can understand what their hedging flows are based upon variables in option positioning. That reflexivity is part of the reason why you have probably experienced something called a gamma squeeze. Gamma squeezes do not exist without dealers and market makers. They do not exist. It's only because of that reflexivity of the option dealers and market makers that gamma squeezes exist. And so they are one component of a gamma squeeze and an essential component. So this reflexivity, if you think about a reflex, if I blow in my dog's eyes and he blinks, that's predictable. With the options market, it works the same. There are predictable flows coming in and out of the market. And that is an advantage for us. So with all those things, does that make sense? Yes, no? Okay. Put a 1 in the chat, or a yes if that does. Put a 2 if it doesn't. And if it doesn't make sense, then put your 2 and let me know why. Richard Judge says, good evening, Chris. Good evening to you, Mr. Judge. Listen, learn, apply. I appreciate that. Okay, it seems like everybody's getting it. Before we go in, it's been getting a little warm in here. Do y'all mind if I open the window real quick? I just want to get a little airflow in here. Is that okay with y'all? Okay, give me 1 second. Appreciate it. Okay. Appreciate it. Thank you.
Hey, Chris, can you hear me?
Yeah.
Really quick, we're getting a ton of questions here about the option school.
Oh, please.
Yeah, can we just show it to them really quick, the portal, so they can take a look at this?
Do you want to take over real quick?
Yeah. Let me do this. All right, guys. So we're gonna show you here the Benzinga option school. It already launched. So you're gonna see pretty much the lessons and everything. Can you see that, Chris?
I do.
Okay, so this is the homepage. When you go in the header, if you can see, if you click live, that's where it takes it to the live class whenever it's live, of course. We have a video library. So yesterday was our first class. We've actually had two classes, right, Chris?
Yes,
Two.
we've had two so far. Today was day 2.
Yes, today was day 2, right? So you can see right here, guys, both lessons recorded, both Q&As recorded. Office hours have not happened yet for the week, so they're not there. But this is where you can find all of the prior recordings, understanding option Greeks, all that when we can get into that. And it also comes with Benzinga Pro, so you're going to get all these features included for those that are asking, the scanners, everything, all that. And you have your chat rooms as well inside the trading school. And inside these chat rooms, you're going to have a student trade idea chat room, a chat room for questions for Chris, general discussions, Chris trade ideas. So you're going to have a lot of things that are happening. So this looks pretty nice. I like it. It looks nice, Chris.
Yeah, I'm really liking it. And it's, this is only day 2 and it's just going to continue to get better and better. Keep in mind, we have hundreds of members in there. So the more eyes you have on the market, the more trade ideas there are. Sometimes traders have a hard time coming up with ideas. Sometimes I'm sitting there going, I'm not seeing any trade ideas. And then one of my students is like, hey, I'm thinking this option on this. And I'm like, dang, that's a really good idea. So it's important to understand the value of that just in the trade ideas alone and the community access. And you don't feel alone because you feel like, hey, there's all these other people going through the same process as me, all learning the same things. So I'm just super excited. We've already been in day 2, and the members that are here listening to this podcast right now, they can tell you how much they've really been enjoying the class so far.
Yeah, absolutely. Just wanted to get that out of the way since we're getting questions on it. And I'll just post the link in the chat for you guys. And I don't want to take too much time out of this, honestly, because Chris has a great presentation, but we also have to address the questions here. So let's go ahead, Chris, and carry on, man.
Great. Okay, I'm going to take over the screen again, and let me get to screen 4. All right, put a 1 in the Zoom chat if you can hear me. Or sorry, not hear me, if you can see the PowerPoint again. By the way, I noticed some of you are putting out tickers and stuff like that. We will have a time to look at tickers after we've gone through the presentation. So just save your tickers, and then I'll say, okay, it's time for open callouts. And then I'll give you the format for giving me those callouts. So I do want to take, before I move into the next slide and part of the lesson, I do want to take a few questions here. So let's see here and check in with my YouTube peeps. Where are you at? Okay. Let's see here. Jeremy Doucette says, Chris Capre, fantastic caring mentor. I appreciate your time, my friend. Thank you, Jeremy. I appreciate it. You've been awesome, and I'm just super impressed with how much you've grown as an option trader. Sarah Sirio has a question. Is it true that there is never any intrinsic value left at expiration? If the answer is no, then the IV inverse function time. Okay, we'll get into that in a little bit. That's not quite. I want to see if there are questions specific about this. Dennis Silva, what is the best way to minimize losses or hedge call options? We will get into that. We're going to get into some calls and puts shortly. And then after we've gone through all of this, we'll address that question specifically. Pippo saying, Chris, a natural teacher. I signed up for Benzinga Pro just for his course. Wow, I'm glad to hear that. I used to see Greeks and did Greeks till Chris explained them. I'm glad to hear. Okay. How do you find this reflexivity? I will start to get into some of that. And I think it's one of the last slides in this presentation. And so we'll explain some of that. We actually have a whole 2-3 hours of lessons in the Benzinga Option School just on finding options reflexivity. But I'll have one slide on that in this presentation later. So we'll get into that. Chris, a great teacher. I'm Macron. Thank you. I appreciate it. How can I watch on Zoom? I think you have to sign up for it, and then they'll give you a link to it. Only day 2 of the class for me, and I already want to sell laddered collared put on June options. That's funny. What percentage of options expire worthless on average? I haven't seen the latest statistics, but the last time I looked at them was roughly 83-84%, which should automatically give you some ideas about how to trade options. If 83-84% of them are expiring worthless, then that means if you're selling options, you probably, might have really good incentives, assuming the right conditions, to hold that through expiry. If you're long options, then it kind of gives you the incentive to get out of it before expiry. So it's important to understand that. Could you explain cash settled options like VIX? Possibly, if we have time for that. We got a few things to go over. Gary R. Chris is taking all the confusion about trading options in the school program. Says teach yourself, makes it easy to understand and follow best investment you make. I appreciate that, Gary. Thank you very much. Okay. How long is the presentation? Will replay be available? It'll be about 2 hours, and they'll make it available live on YouTube. So stay tuned. Okay. I feel like I've gone through other questions there. With that being said, let's go over, just for those of you that are new to options, let's go over some of the basic mechanics of how the option market works. I'm not going to go over all of them because that could be 2 hours in and of itself, but I do want to go over some of them so you feel like, hey, I understand this a lot better now. So the option market, the best description that I can, or best analogy that I can use, is this kind of insurance analogy. So let's say I want to buy health insurance. Like in the US, we have to buy health insurance. And so if I want to buy health insurance, I'm going to be a buyer of that insurance. And I am buying insurance or a contract to a seller of that insurance. Okay, it's important to understand buyers and seller relationship here. In the US, if I'm not an insurance provider, I can only buy insurance. That's all I can be. I can't sell insurance if I'm not an insurance provider. But I can buy insurance and I pay a premium for this contract, this health insurance contract. That contract is provided to me by the health insurer. They are selling me the insurance and they will charge me that premium. So let's say my health insurance is, $8,000 per year. Like last year, the year before that, I think I paid roughly $8,000 for the year. So that was just for me. And so I paid the $8,000 premium to the health insurer. With that $8,000, they get to keep all that $8,000, but then they have to provide me a contract. And if something happens, they have to pay me, based upon the contract terms. But it's really just it's really just a unidirectional relationship. I can only buy. With the options market, you actually have the chance to be the buyer or the seller. And that's very important to understand that. So you can be the buyer, and we know what being the buyer is like. I pay a premium for that contract, and the premium goes to the seller. In the options market, though, I can also be a seller of that option contract. And if I sell that contract, say to you, you're going to pay me a premium to give you that contract. Now, if I sell the contract, that makes me responsible for how that contract plays out. And I agree to all those terms of that option contract. But the bottom line is, just to even sell you the contract, the moment I sell it to you, you instantly pay me. And that goes into my account as a credit right away. So this is a general approach that option traders make, is that they become option sellers. They sell these contracts and they're constantly collecting income for selling those contracts. That's pretty cool. If you're just buying and selling stocks, buying and selling FX, buying and selling commodities, you don't have the option to get paid the moment you sell that trade. You don't get that option. You have to put a margin, you sell it, it has to go in your direction to keep that money. If it doesn't, you don't. With options, I sell you a contract, that money goes instantly into my account. It's pretty cool. So for those of you that don't know that just trade stocks, this is one of the unique benefits of the option market. So that's kind of that's the best analogy of how it works. These are contracts, though. They're on stocks, and they're based upon a few variables, which we'll get into. But the great thing about the options market is it's between buyers and sellers, and you yourself can either be the buyer or you can be the seller. Super important we understand that. Now, the contracts that are traded are called calls or puts. There is an elaborate definition of calls or puts, but a very simple definition of calls and puts is very straightforward. A call option is a contract that increases in value if the stock price goes up. it also decreases in value if the stock price goes down. So that's kind of a simple way to understand it. A call contract, so let's say this call is a contract that goes up in value if the stock price goes up, and that call contract goes down in value if the stock price goes down. It's very mechanistic, okay? A put is slightly different, but relatively the same. A put contract is a contract that will increase in value. It will make money if the price goes down. And it will lose value or money in that contract if the price goes up. Does that make sense? Yes, no? Put a 1 in the chat if that makes sense. Okay, if you put a 2, then let me know your specific question on why it doesn't make sense. Pitbull saying selling out of the money covered calls is a great way to safe way to pocket theta decay. Yes, we'll get into that. Okay, seems coming in. What is the difference between a short and a put? So a short and a put are not the same. The calls and puts are the types of contracts that we trade. Now you're getting into long puts, short puts, long calls, short calls, and I will get into it. Do I even have a slide on that? Let me check. No. Okay. All right. So with that being said, there are 4 ways you can trade these. You can do a long call, which I often use or write a plus C. The plus means I bought that call. Or you can do a short call, which I write a minus C. And that's 2 ways you can trade the calls. Again, I can be the buyer of that call option, or I can be the seller of that call option. Just like the insurance company, I can sell the insurance or I can buy the insurance. The other way is you can buy a put, which is LP, but I write plus P, or you can sell the put, which is minus P. Now, let's just briefly explain those. So remember, a call option is an option that gains in value if the stock goes up in price. So if I buy a call option, I want the stock to go up in price. If I sell that call option, I do not want that stock price to go up. I want it to go down. The reason being is I sold that contract. If it goes up, if I sell that contract to you for $2,000 or $200 and the stock price goes up, that option contract, that call could be worth 300, 400, 1,000. And then you could say, you know what? You have to pay me now. I'm closing this contract. You have to pay me. I am responsible to pay that. So you can trade a long call and you will make money if the stock goes up. But if it goes down, you're going to lose money because calls lose money if they go down, if the stock price goes down. Now, I don't have to be a call buyer. I can be a call seller. And so if I'm a call seller and the stock price goes down, I get to keep the money that I made for selling you that call. Because remember, when I sell you the call, you instantly pay me. And if I sell you that call and the stock price goes down, that contract I sold you, that bike, that car, whatever it is I sold you, it's worth less. And it keeps losing value as the stock goes down. That's what I want. So now I can be like, hey, I think the stock's going to go up. I'll buy a call. Or I think the stock's going to go down. I'm going to sell a call and I'm going to collect income. You're going to pay me for selling you that call. So these are the basic mechanics of how a call works. For the puts, it's just simply invert that. So for the puts, a put is a contract that makes money if the stock goes down. And so if I buy a put, if I buy that contract, I want the stock price to go down. And if it goes down, that put is now making money. It's gaining in value. It's gaining in value. So if I buy this put and the stock price goes down, I make money. I make profit on that contract. And if the stock price goes up, then I lose money. My put is worth less. This is that basic mechanical nature of the options contract. Any questions on that before we move forward? Richard Judge says, what's a good way to play weekly options? We'll get into that in a little bit. There's no fixed answer to that. There's a million ways you can do that. We will start to get into, strategies and things like that, but there's a lot to answer that question fully. There's a lot of things you need to know and skills you have to have in place to do that. It's not as just simple as, hey, do X, Y, Z, and you're good to go. There's a lot more to it than that. But we'll get into that if we have time a little bit later. Okay. Checking in questions. Eric Evgray is saying, you've explained how they function, not what they are. I've done a little bit of both. I've said a call contract is a contract that gains in value if it goes up and it loses value if they go down. I did that because that's a simpler explanation than the more technical explanation. The technical explanation is, if I want to really explain it, so we covered this here in my little presentation, and I have it all written out. Give me a second. All right. 1 second. Okay. And I'm going to show it to you visually because it's a lot easier to remember. Okay. A call option definition is a contract that gives the option buyer. Remember, buyer is different than seller of that contract. I buy the contract, that's different than a seller. It's a contract that gives the option buyer, not the seller, the right, but not the obligation to buy a stock or underlying asset at a particular price at a particular time. Now, as Eric has pointed out, I've explained more the function and not what they are. The problem is, I'm willing to bet for most of you that have heard that for the first time, that seems a little bit more confusing and complicated, and it is. So I have to now unpack all that. There's a reason why I didn't do that, Eric, because this means I have to spend a lot more time unpacking this. I personally don't think it gives you that much more information, but I'm going to do it anyways. Okay, so we talked about buying and selling contracts. Call option, again, it gains in value if the stock goes up, and it loses value if the stock goes down. So it's a contract that gives the option buyer, I'm buying the call option contract, the right, but not the obligation to buy a stock at a particular price. Okay, let's unpack this a little bit more. If you've heard this for the first time, that probably doesn't make much sense. And you probably have a lot more questions than my simpler explanation. So with that being said, okay, what does this mean? What does it mean that I have the right, but not the obligation? If I buy an option contract, I have two ways that I can two outcomes that I can kind of deal with it here. I can say, you know what, my call option's gone up in value. I would like to convert my option position into a share position. When I trade options, I'm not buying and selling the shares directly, but I am trading a contract. It's what we call a derivative. Just like CFDs are called contracts for difference, you're not actually buying and selling the stock. You are buying a contract with your broker or market maker that they agree to pay you if it goes in your direction based upon the price changes. And if it goes against you, they're going to debit you. It's a contract based upon that. Options is very much like that. If I buy the contract, I have the right, but not the obligation to buy a stock at a particular price. So I have the option to say, you know what? I'm long SPY calls at 450, whatever price, doesn't really matter. Let's say 450. And I would like to convert my contract into a long SPY position. And so I would exercise that. and then I can be long stock. But I don't have to do that with the option. I have options. I can say, you know what? I don't want to convert it into a long stock position because I don't want to own the stock. I just wanted to buy the contract and make money on the contract. And so then you can just say, you know what? I'm going to close this contract and I'm going to for that profit. So you have the right, but not the obligation to either get the stock or not. Now, for those of you hearing this for the first time, was my first explanation easier or was this definition easier? I'm probably willing to bet it was the former, not the latter. There's a reason why I did that, Eric. I did it for a very specific reason, because I want to start with the simple explanations and then work into the more complex definitions. Can Chris explain this with a live example? Sure, we'll get into that shortly. Will you go over call and put strategies such as vertical straddle strategies? We don't have all the time to go over those. I will go over simple calls and puts. A lot of people in here, this is first time trading options. So if I start talking about vertical straddles, they'll have no idea what I'm talking about. And so I don't want to go over the heads of too many people, but I also want to explain things for those of you who are a little more seasoned or advanced. We do have in the Benzinga option school, how many lessons on strategies? We have a total of one lesson on single legs, another lesson on two legs, another lesson on 3 and 4 legs. So 3 separate lessons. And I think we cover a total of like 12, maybe 15 different option strategies. So I don't know if we'll have time, but if we have time, I'll try and get beyond calls and puts. Okay. With that being said, what is the difference between selling calls and buying puts? This is a great question. So selling calls will make money. So a call makes money if the stock goes up and it loses money if the stock goes down. If I sell a call, I have a certain exposure that I wouldn't have if I bought a put. So a call is one that makes money. I make money if it goes up and I lose money if it goes down, if I buy that call. So if I plus C buy that call. But you're asking what happens if I minus C it. So if I sell that call, it's the opposite. If it goes down, that call becomes worth less and I keep that profit. If it goes up, I have exposure. So if I sell a call and the stock goes up, technically stocks can go to infinity. That means I have unlimited upside risk. Now that will change if I own the underlying stock, but I have unlimited risk if I sell that call naked. That's different than if I get long a put. If I get long a put, I have a fixed risk, a fixed price. If the stock goes up to infinity, I lose no more money on the trade. However, if the stock goes down to 0, I have a convexity for how much profit I can make. I do not have that convexity by selling a call. So there are major differences. Another more detailed answer to that is a put means you're long gamma. If I sell the call, I'm short gamma. So I'm short gamma. And those have different implications, probably beyond the scope of this lesson, but hopefully that gives you some idea. There's more nuance to that. There's more things I can say, but I don't want to, spend too much time in that. Okay. How long do you have to hold a call to sell? There is no fixed amount of time. With American style options, which is what I'm talking about and what everybody trades, at any point in time you buy that call, you can sell it and close it at any point in time up to the expiry. Just like my insurance contract only has a contract for a year or for 6 months or whatever it is, option contracts have an expiration. They have a time that they're valid, and after that, they're not valid. You determine ahead of time how long you want that contract to be valid. And any point, let's say you say, hey, I'm going to buy a contract that can expire 30 days out from now. You're like, okay, you don't have to wait 30 days though. You can close it. I can open it and close it in 2 seconds. If I made profit on it, I can do that. So you're not bound by time in terms of how long you keep it open. That's up to you. For beginners in option trading, what is a safe bet? Long call. That depends. That's not in the beginning. I generally recommend only doing single legs, long calls, long puts, short calls, short puts. However, I do not recommend for beginners selling naked calls or selling naked puts. That means you don't own the stock. You don't have an underlying position. That means you have pretty much unlimited risk. So that's why I don't recommend it. So single legs, which means you're just trading one call or one put. That's my recommendation. So is buying a put and selling a call basically the same concept? You lose if it goes up. It's the same in some ways, and in other ways it's not. There's different risk profiles for each one. Guillermo Lopez, is there an advantage to owning a stock in which you do own options with? Sure, absolutely. If I own a stock, then I can use options to hedge or to add on to my position or to make profit through increases or decreases in volatility, through the passage of time, through the repricing of risk. That's that slide again that says, hey, these are all the different ways you can make money. So yes, a great question. Skip Martin, they've already answered that. This is YouTube, so the video will be available. Do you have to own a stock to buy a put? You do not. We can see how and why we choose one contract according to the offerings in the market. How to read. The focus of this is not about how to read Yahoo Finance. That's not the focus of this. Focus on options trading. If we have time, we'll get into some basics of why you would buy a call and put. Yeah, as I suspected, everybody said the first explanation of calls and puts was easier. Okay. Matt Berlindo, I joined late. Will recording? Yes, they'll be available.
Hey, Chris, really quick
yes.
here. Just want to give a shout out here to Melissa, Joan, and Tim for joining the Benzinga Option School here.
Welcome aboard. Good to have you here. Welcome aboard. Thanks for joining. I appreciate you not covering all those strategies. Yeah, this is not, if I had a whole webinar on strategies, I would do it, but yeah, we don't have the time for that. Okay, I think I've covered most of that. What about spreads? Will you cover that? We probably won't have time, but we do cover that in the Benzinga Option School. By the way, Craig Combe, you're asking a question Q&A, as I mentioned in the beginning of the program. Put all your questions in the chat. Otherwise, I have to look at too many windows. Can I increase the number of calls or puts as the price action changes? Yes, as long as you have the money and margin for it, for sure. Alex Salmon, if the buyer of the option to buy this, if the buyer has the option to buy the stock, you have to own the stock to sell the call option. No, you can do it naked. You can sell naked calls. Why can't you, Stefan Slagle says, why can't you just collect premium by selling options and then close your positions immediately? You could do that, but the thing about it is that when you close the position immediately, you're going to close it for the value of that contract. So if the contract hasn't changed in value in your favor, then you don't get to keep that premium, because it's kind of like I go to buy car insurance from my car insurance brokerage. I pay $3,000 for the year. And then I buy that from them. I sign the papers. And then 2 minutes later, I'm like, you know what? I want to close this car insurance contract. They're going to refund me the $3,000, but I'm going to have no contract. So that's how it's important to understand that the contract value has to change for you to pocket a profit. How to read tables of options and how to set an order ticket in my brokerage system. So Jose, the goal of this webinar is intro to option trading principles. Because we have people from hundreds of different countries here, that means they have hundreds of different brokerages. And so it's not really efficient or the best thing for me to do to explain, hey, here's how you use your brokerage. My suggestion is to go on YouTube and find your brokerage. They will have videos on how to initiate a contract. Yeah, contact your broker on that. They should have videos on their YouTube channel. Okay, I think I've gotten most of it. Let me check with my YouTube people real quick. And then, can you buy back the contract you sold if it starts to make you money before expiration? Yes, you can close it. With American options, you can close at any time before the expiration. Mr. Ortiz, C. Ortiz, what is the likelihood of early assignment? Is there a way to mitigate this? If you sell option contracts, you are always exposed to early assignment. And so that is the risk you take on for selling contracts. And so with that being said, Are there ways to mitigate it? Yes, you close the contract so you don't get assigned. Keep in mind, though, as I mentioned, about 84% of all contracts roughly expire worthless, and a very small percentage of them are actually assigned. In 2021, I traded about 500 option trades, and I think I only had about 3 or 4 that were assigned. So it's a pretty low probability event. But if you're worried about that, then just close it and be done with it and move on. Jose Mesker, about how to understand the puts and calls tables. That's the option chain. Again, there are free videos on how to understand the option chain. With that being said, if we have time towards the end, I can show you an example of the option chain, but I have other things I want to present. Does everybody want me to go through the put option definition, or would you rather just me move on with the presentation? There are advantages and disadvantages to it. 2 is no, move on. Okay. Votes are moving on. Let's do that. Okay. All right. Okay. Okay. So we've covered call and put basics. We've talked about buyer and seller. It's important to understand that when you buy these contracts, these calls or puts, there are some variables you have to understand. There are many variables you have to understand, but 2 of the most common ones are the strike and the expiration. All contracts have a date that they expire. And so you have to choose ahead of time, when you choose this contract, what is the expiry date of this contract? This is challenging for new traders, but it's also something that will enhance your skills as a trader. Because if you buy and sell Apple stock, yeah, you may care if it hits your profit target in 1 or 3 hours, but you don't get to decide how long it takes for you to get there, and you have no control of it. So you're kind of just a passive observer on the Apple stock bus waiting for it to get to your price. You don't get any say so really on whether it gets to its target or not. So you don't really think about time too much other than, hey, my trading strategy says I should hold this for this long or whatever. With options, because you're picking these expiry dates, times between now and then that this is going to expire, 1 day, 0 days, a week, a month, a year, it forces you to start thinking about, hey, how much can this stock move over time? That's a challenge in the beginning, but it also builds skills. And so it's important to understand that, because as you build these skills, that will start giving you better ways to time the market. So it's super important. And that expiry, EXP, is in every option contract. Also, there is a strike. The strike is the price that you are buying the call or put or selling the call or put at. It's basically saying, look, if I buy this call, let's say I buy a 450 SPY call, okay, and I pay $5 for it. In options nomenclature, each single contract, one contract, is equal to 100 shares. Okay. And so if I spend $5, the math is $5 times 100 shares, $500. So for each option contract, for example, I might pay $500 to buy, one call. If I buy 10 calls, it's 5,000. If I buy 100 calls, it's 50,000. Okay. So let's say I buy one call at $5, which is $500, to buy SPYs at the 450 strike. That's the strike. Okay. My expiration is the time when this contract's going to expire. And so let's say I say, hey, the January monthly expiry, which is January 21st, that is my EXP. So I have between now and January 21st to either make money in this contract, close it out, or exercise it and convert into long SPY shares. Okay. So I've bought one call, we'll put a plus C at 450 strike on the SPYs for the January 21 EXP, January 21st expiry. Those are basic mechanics for all contracts that you do. And so these are kind of basically what it means is that if SPY, let's say SPY is 450 today, but by January 21st, it closes at 475. Okay. This is where it's closed at. I have, at the date of expiry, I have the option to, or even before the expiry, to say, you know what? I want to convert my call into a long shares position. If I do that, I exercise it, and then I'm going to be long SPY shares at 450 if I exercise that call. Since the market's at 475, I have an instant realized profit of $25 per share. Each contract is 100 shares, so $2,500 in profit. But I don't have to do that. I have the right, but not the obligation, to convert it to a stock position at 450. I don't have to. If I bought this call for $5 and calls go up in value as the price goes up, maybe this call is worth $32 by then. For whatever reason, variables, Greeks, pricing, and all that. Well, I can say, you know what? I'm going to sell the option because I'll make, what is that? $2,700 profit instead, $2,500 profit or whatever. The bottom line is I have the option to just say, nah, I don't want a long stock position. Just give me my profit, close the option, done. So the strike and the expiration, these are basic components of all option contracts. Anytime you pick a contract, you will pick the strike, you will pick the expiration, you will pick whether it's calls or puts, you pick all those details. Any questions on that before we move on? I feel like I've done a good job already covering the mechanical nature of all this. So I just want to make sure. Put a 1 in the chat if that makes sense. Put a 2 if you have any questions on that. If you do put a 2, then please post your question.
Chris, and if they're enjoying the session, like this is just a sneak peek of what you do in the option school every day, pretty much for like hours.
Yes, and we don't go over the same lesson every day. We go over different lessons on a rotating schedule. Yes, so we go over, we explain all this, but this is just a small version. We go into much more detail for the members of the option school. Okay.
Yeah, because I see they have some people have a lot of follow-ups, and kind of like the format would fit for these folks.
Sure. Okay. So this is option mechanics. Okay, now option Greeks. Okay. Greeks are complicated. By the way, Brittany Perkins, as I mentioned earlier in the webinar about 5 minutes ago, and in the beginning of the webinar, maybe you missed it. Please post your questions in the chat, not in the Q&A. So I only have to look at the chat window. Thank you in advance for doing that, by the way. Okay. Understanding option Greeks. So I've mentioned before that Greeks are, and I kind of use the ski analogy, these are just variables that influence the price of the options. Okay. So just like if I'm a skier, if I have 2 inches of powder versus 2 feet of powder, those are 2 variables that are going to affect the condition. What's the variable? Powder, and how much powder I have. 2 inches of powder versus 2 feet of powder. Those are 2 different conditions. If the snow is wet versus very dry, that's going to be different. So if I have no powder and it's just like a very packed surface and it's dry, that means my skiing conditions are going to be fast. They're going to be hard. But if that snow is wet and kind of slushy, maybe it's 40 degrees Fahrenheit out there, well, then that's going to slow my skiing down a little bit, but it'd also be more forgiving on my turns. So these are variable conditions that affect skiing. Different things of snow, weather, sunlight, all this stuff affects your skiing and snowboarding. The Greeks do that same thing. They are just variables that affect the pricing of that option, of those calls and puts. And so this is a simple explanation. It is also mechanical. There are 3 main Greeks that are most often talked about: delta, gamma, and theta. I would like to take 5, maybe 10 minutes explaining delta, so you kind of get an idea of how these Greeks affect pricing. Okay. They're generally considered 3 definitions of delta. And I'm going to tell you what I think is the best of these 3 definitions. but these are three definitions that you will commonly hear about delta. The first definition is ROC, which stands for rate. OC stands for rate of change. Okay. The rate of change of an option value as it moves $1 up or down. So for example, let's say I buy that same 450 plus C, which is a long call on SPYs at the 450 strike. And let's say I have a 30 days to expiration, 30 DTE, which stands for 30 days to expiration. That's my EXP. And let's say I pay $5 for that call. Okay. Which $5 times 100 shares, it's $500. And I buy one call. Okay. We'll just put one call there. All right. If I bought the 450 call and let's say here's the price. Let me delete this. So let's say here's the price of SPY. And right here is 450. And this is 445. And this is 455. Okay. For every dollar this moves up, so like 451, the price of my contract, my call, is either going to increase or decrease. In this case, I'm long the calls. So it's going to increase in value. How much is it going to increase in value? That's based upon partially the delta. The delta is the rate of change. How much does this $5 option contract move up if it goes up $1 or move down if it goes down $1? So let me give an example. I bought this for $5. Let's say I have a delta, this is the Greek symbol, roughly, of 50 cents. Okay. I paid $5 for this option contract for a 450 call, and it moves up to 451. How much is this $5 call worth at 451? It's worth $5 plus the delta, which is 50C. So it's worth a total of $5.50 at 451. Now there's other variables that are going to affect this pricing. I don't want to get into all those, gamma and theta, but this is how pricing of contracts changes over time. This is probably, Greeks are some of the most complex aspects of options. Once you get past the Greeks, it gets a lot easier after that. Why am I talking about the Greeks right now? Because when you start to understand the Greeks are what should be looked at as trading opportunities. Just like going back to the ski analogy, I'm going to have different opportunities on the ski hill if I have 2 inches of powder versus 2 feet of powder. If I have more powder, I can probably take more aggressive jumps because when I land, I'm landing in 2 feet of power. That 2 feet of power is going to cushion my fall. But if I only have 2 inches of powder, that's not going to cushion my fall as much. So when I hit the ground or I hit back the mountain, the snow in the mountain, I get a bigger impact. That means I can't be as aggressive on some of these jumps because I don't have as much cushion. The Greeks are very much like that. They give you opportunities or they say, you don't want to take this opportunity based upon the pricing. So we had talked about how you can make money via time. You can make money via volatility. You can make money via repricing a risk. You can make money via direction. You can also make money exclusively trading Greeks. So you now have more and more business models a way to make money. There is one Greek that has to do with solely volatility. It's called Vega. And there are option traders that just trade that. That's all they're trading is volatility. They just really isolate that as a variable, find dislocations in pricing and say, there's an opportunity, I'm going to trade that. Doesn't matter about direction so much. Doesn't matter about time so much. I think volatility is going to expand or I think volatility is going to track. That's trading Greeks. It's important that you understand these Greeks because they will give you a lot of information about how options work. So this is one definition. Another definition that you often hear about delta is it's a value between 1 and 0. While that's technically true, it's not really that informative. It's only so informative about delta, and it doesn't capture the whole picture. So if you see that definition of delta in the future, my suggestion is take it with a grain of salt. It's not the full definition. Another common definition you hear is delta is the probability that your option expires, ITM, which stands for in the money. In my opinion, this is also not a totally accurate definition. It's not mathematically precise. And just because I buy a 50 delta, this variable is always in flux. And so it's not really an accurate assessment of how likely this option is to expire in the money. So really the best definition of delta out there is this one, A, rate of change of the option's value for every dollar move in the stock, up or down. Okay. Any questions on this before I get into these point 2 and point 3? It's all Greek to me. I know Greeks are hard to learn. I think this is part of the reason why a lot of people don't learn options, because it's just so much more complex than stocks. So it creates this kind of barrier to entry. The good thing about barriers to entry is it limits the amount of people that learn it, and therefore there's less people learning it. But it also means that, I look at it as there are more ways to make money. And so if you can get past the complexity and all of the complicated language, once you really learn and understand it, it no longer is a weakness. It becomes a strength. It starts giving you different ways to find opportunities in the market. Okay. Chris Gaskins, good name, by the way, Chris. My name's Chris. When thinking about theta, so we haven't talked about theta, we're not really covering it, but let me hear your question. Does it impact the option pricing when the market is closed, like the time that's passed over the weekend? Yes. So theta accumulates for every single day, calendar day, not every single trading day, but every single day. In other words, so for those of you who don't know, theta is an option Greek. It has to do with time. It's often called theta decay, time decay. So if I buy options, I'm exposed to this theta decay. And if I buy an option on Friday and I hold it through the weekend, I'm going to pay theta on Saturday, Sunday, and Monday. That means my option is losing value. So you lose theta decay for every day you hold that open, not every trading day. So if you hold it through the weekend, you're going to pay theta. Omid says, how is rate of change calculated? It's through a Black-Scholes model mathematics. It's not important, to be honest. Whether you know it or not, it's not going to make a difference for you as an option trader. It's complex mathematics, yeah. And I'm not good enough to explain the complex mathematics. Okay, let's see here. Any questions? Tom says you explain it perfectly. Thank you. I appreciate that. Louis Morin says, if you don't exercise your call, who keeps the 100 stocks, the 100 shares of stocks? Nobody, because it wasn't assigned. Remember, the contract is only a potential to own the stock or control stock. If you don't exercise it and assign it to somebody, then those shares don't get converted. That option doesn't get converted into a share position. Okay. All right. Seems like there are no more questions on that. All right. So let's get into point 2 and point 3. And then, we do have one more question for Chris. If the stock price goes up $1 and the option value moves by the value of the delta, what will the delta become? I heard something like delta will then go up by the value of gamma. Yes, but we're not focusing on gamma today. One Greek is enough. And so, yes, that's true, but I don't have time to explain that. I literally have a half an hour and I still got a lot more slides to go through. So yes, we cover this though in full in the options, Benzinga option class. Okay. Real briefly, this probably doesn't have to be covered too much in detail, but calls have positive delta. So calls have positive delta and puts have negative delta. Why is that? The reason being is that a call has a positive relationship to the stock price, correlation to the stock price. What do I mean by that? Well, calls go up in value if the stock goes up, and calls go down in value if the stock goes down. That's a positive correlation. Stock goes up, calls go up. Stock goes down, calls go down. Positive correlation. Puts have a negative delta because they go in opposite. Puts gain in value if the stock goes down, but they lose value if the stock goes up. Stock goes up, puts lose value. That's an opposite correlation. Stock goes down, puts gain in value. Again, opposite correlation. This isn't too important for you to know for beyond the sake of this thing right here, but if you get into more advanced aspects of Greeks and delta and options, then it is valuable to learn. The last thing I want to say about delta is not constant. Just like weather is not constant, delta is not constant. It's a variable that's always in flux. And the things that affect it the most are what we call moneyness, time, and volatility. Moneyness has to do with, is your stock or your contract in the money, out of the money, at the money. At the money is at the exact same price. In the money, depending upon call or put, would be above or below. Out of the money will be dependent upon above or below. So the moneyness, how much is it in the money or out of the money or at the money, affects delta. On top of it, time affects delta. As time moves on and get closer and closer to that expiration, delta changes. And then also volatility. Does a stock move pretty volatile up, down in a day? Or does it only move in a small range on the day? That will affect deltas. So delta is this constantly changing variable. That may seem complex, and if it's your first time hearing it, it is, but after a few times, it actually starts to make sense. So if it doesn't make sense fully the first time, it's not a big deal. It's just important to understand that delta is not a fixed variable. It's constantly evolving over time, moneyness, and volatility. Okay, moving on. Learning option strategies. All option strategies, this is again the great thing about options. All option strategies are versions of calls and puts or a combination of them. Every single option strategy out there, whether it's a single leg or a vertical, spread, or it's a three-legged one where you're doing a butterfly or, whatever. Every single version of an option strategy is is always constructed of these basic building blocks of calls, of puts, or any combination of calls and puts. The great thing about that is there's only so many mathematical combinations you can do. That's the great thing about options. The strategy part is not the big hunt, the big hunt for the red October that everybody goes for when they try and trade stocks or crypto or whatever. Everybody's like hunting for the strategy, which is actually a mistake because there's many things you need beside a strategy to make money trading. In options, they're just like, hey, here's all the strategies. These are all the mathematical combinations you can do. The skill is in learning how to leverage each one, when to use it, when not to, and how to apply it best. So they kind of take the mystery out of it. Hey, here's all the strategies. These are easy to find. You can find all the strategies on YouTube. The finding of the strategy, the knowing of the strategy is not the big mystery that it is in other aspects of trading. Options says, here's all of them. The real skill, the people who make the most money are the ones who learn to leverage them at the right time, in the right place, in the right way. And that depends upon the price action, and that depends upon the Greeks. That depends upon all these variables, the volatility, the moneyness, the time. All those matter. The better you get at those individual skills, the better you get at your individual strategies. So that's the great thing about options. It's important to understand that the greater the combinations of calls and puts you have, the greater the complexity the strategy is. The more implications and variables that you have to weigh as it goes on. Buying calls or buying puts or selling calls and selling puts, very straightforward, not complex at all. But as soon as you say, hey, I want to buy one call and sell another call at a different price, or buy one put or sell a put at a different price, or maybe buy a call and sell a put, or buy a call and buy a put, or sell a call and sell a put, or all these different combinations. The more combinations you put into that kind of soup, the more complex the strategy, the more you have to manage. So really, there's no limit to how much complexity you can build and nuance you can build in your strategy. As long as you have the skill, you can put together any combination calls and puts you like. It's kind of cool. Okay, let's take a few questions. Let's see here. Let me cover this last part. As we mentioned, you can go long or short calls. You can go long or short puts. We already covered that. Okay. So any questions on this before we move on? Brian Flaherty has a question. Do you have to own the stock to sell a call? No, you can sell it naked. Okay. The Ajax. How does supply and demand figure into an option pricing strategy? It doesn't. Supply and demand as a theory about the market doesn't. If you're asking about liquidity, yeah, that's going to have an impact. But in my opinion, supply and demand is not the best way to approach options and the Greeks, because it's only going to have so much of an impact. And a lot of that is mathematically done by the brokers. And so instead of looking at it that way, it's far better to look at open interest and volume and gamma exposure from the dealers and hedging exposure to the dealers. Those are far more superior ways than supply and demand. Supply and demand is not the best tool for approaching the Greeks. The things that influence the Greeks the most: moneyness, time, volatility. Those are the three variables that influence them the most. So yeah, it's kind of like using not the best tool to really understand the Greeks and pricing. Richard Judge says, great stuff. Thank you. I appreciate it. Born to be Free says, Chris's approach is cool and calming. Dude knows his stuff. Thank you. I appreciate that. Lil Ragu. So the stock could go to 100 either way during the contract, but as long as it is at the money on the day of expiration, you won't lose money. That depends on what you paid for it. So it could lose money. It could have lost value over time because it's going to lose value over time. It could have shrunk in volatility. Again, moneyness, time, volatility. Moneyness isn't the only variable that affects the pricing. Time affects it, and volatility. Maybe you bought that contract at a high volatile time period in its existence. Well, the more volatile it is, the more expensive that contract is. And if the volatility has changed, that's going to affect the pricing of that contract. So that's not totally accurate. Toronto the Great, I love that name. If you had to choose a stock to own 100 of in order to execute the covered calls, 100 shares, I'm assuming what you're saying, which would it be to maximize the popularity of stock to guarantee a big demand at all times? I think what you're asking is which stock would be good for me to own 100 shares of to sell covered calls on, so that I can make sure that the liquidity is there at all times. There's a boatload of stocks that would fulfill that requirement. Any stock that has an open interest of 500,000, a million contracts, you probably will not have any difficulty selling those contracts or getting out of that position at all. And there's a lot of stocks that fulfill that requirement, a lot of stocks. Obviously, the more options there are, the tighter the spreads, the better the liquidity. The most liquid options instrument out there, SPYs and SPX. Yeah. So if you really want to just make sure you're 100% not have to worry about liquidity, SPYs. By Tozy, would you be looking at the company's data to know when and when not to buy or sell? Possibly. It depends upon the nature of the contract. If I am trading a short-term contract and there's no earnings report in the near future, then the data is not too important, like price to sales ratio. None of those things are really that important to me, because the bottom line is the flows are going to dominate the movement. Flows do not care. Some flows care about whether the price to earnings, price to sales ratio is XYZ or whatever, but others don't. Some of them are purely mechanistic. As I said, dealers will hedge based upon the orders that they receive. If I buy 100 SPY calls, dealers are short 100 SPY calls. They have to hedge that by either buying long futures or long SPYs. That's mechanistic. It has absolutely nothing to do with price to sales, price to earnings ratio. So you have to consider the context in the environment and the flows going on. It's a great question. Okay. Let me see a few more on my YouTube peeps. All right, let's see here. Laragu, Toronto the Great, Baitozi. Okay. Okay, this is a good question. This is a very good question. What is the minimum open interest in volume that you can consider good to enter a trade? Say there's a setup and seems bullish. This is a great question. Okay, for me, I have gradations of open interest. If a stock is below 100,000 options in open interest, I consider that low liquidity. So I generally will pass on that trade. Why? Because I have so many other stocks that are well above it. 500,000, I consider that strong open interest. Once you're above 1 million, you have a tremendous amount of open interest. The data points that you have are really strong. You have very robust data to work with, understanding of hedging flows and things like that. All these things become really robust. So 100,000 is the minimum open interest. Now, in terms of volume, that will depend on whether I'm trying to day trade it or not. If I'm trying to day trade it, I want a lot of volume. And so what would I want the volume to be? At least 10% of the overall open interest. This is a great question. Sarah Siri, does liquidity matter for selling covered calls? Yeah, because it's going to affect the level of the spread of me selling those calls. Yeah. And the pricing. I might not be able to sell them if it's not there. Daniel Davis, is buying single calls or puts worse than spreads? All the pros seem to focus on spreads, it seems. Not necessarily. Not necessarily at all. There are going to be certain... In the beginning, you're far better off trading single leg options because you just don't have the skill level to trade spreads or more complex options. So I don't agree with that statement. But let's say you are a little more sophisticated. Are there certain times to be trading long calls or long puts versus a spread? Absolutely. Spreads do not have convexity to the profitability. There is no you do not get the convexity of long calls or long puts that you would in a spread. And that convexity has massive advantages. The people who made the most money on the AMC and GameStop, gamma squeezes, they were people who made money being long single leg options, not being long spreads. Because after a certain point, you've maxed out your profit on the spread. But if the stock continues to squeeze, you're going to rather be long calls than you're going to want to be along a bull call spread. So I don't totally agree with that statement. It's more of like right tool for the right time. So hopefully I answer your question. Let's see here. What's the difference between open interest and volume? Open interest is the total of contracts that haven't been settled. Volume is just the number of transactions that have been transacted throughout the day. Some of those can be opening transactions, meaning they're initiating new contracts. Some of them can be closing. So volume is just total number of contracts traded for that day. Open interest is the number of contracts not settled. It's a good question. Let's see here. Okay, hopefully I answer your questions on that. Let me check in with my peeps here in the Zoom, and then we can move on. Ayana is saying that was the most efficient and understandable definition of delta. Thank you. I appreciate that, Ayana. Chris Gaskin says, one last question, Greek's question. On your example earlier, the value of a put or call may increase even if the stock is sideways, earning anticipation. Does a scenario like that reflect in the Greeks? Yes. Yes. It'd be reflected in the premium. It'd also be reflected in implied volatility. How can we access this recording? It'll be saved for later. It'll be made available on YouTube. Femio, if you have the stock, can you sell an option contract? Yes, you can also sell a contract on it without owning the stock. It's called naked. And for those of you asking, so as I mentioned before, maybe you haven't joined, but please, if you're in the Zoom, please post all your questions in the chat, not in the Q&A. So if you have posted in the Q&A, please copy paste it in the chat if I can. So this way I only have one box to look at. If I convert a losing call position due to time negated shares before expiry, can I salvage that trade that way? Yes, but then you're going to be underwater on the long stock position. So the stock, like if I buy 100 call in something and you wanted to convert it and the stock's like lower, then you're going to have to pay the difference because the stock's lower. So you're not salvaging it. Yeah. Is it a waste of time, waste to buy options that are out of the money to begin with? No, again, right conditions, right place, right time. I don't believe there are many, many environments where buying out of the money calls can be highly profitable. Once you start to understand the Greeks more, particularly gamma and convexivity, that changes. Can you put stop losses on options? Yes. Is selling a call risky without owning it? Yes, your risk goes up massively because you have technically unlimited risk. A stock can go to infinity technically, which means you have unlimited upside risk. Can you explain the PDT rule, the pattern day trading rule regarding the options trading, please? Yes. Well, it's not any different. You're only allowed so many day trades within. If you're below the PDT rule, which is 25,000 in the US, then you can only trade so many day trades within a week. And if you go over that, I think it's 5. I don't know because I've been over that number for so long. It's been forever for me. I think it's 5, maybe it's 3. I don't know. But if you go over that in a week, then you're going to be in violation of that, and your broker will not allow you to do any more transactions, maybe closing only, or you have to increase margin to do that. With options, there is a slight way around that. Now, if you make an option trade, you're below the PDT rule, you're below 25,000. If I make an option trade, let's say today, and I close it before the market closes, that is considered a day trade. So that will count towards your PDT rule. However, if you make an option trade that is expiring at the end of the day and you let it go through to expiry, technically that settlement doesn't happen until after the market closes, and it's not considered a day trade. So that's an option kind of day trading hack around the PDT rule. 0 days to expiration, hold it through expiry. This is a great question. So Stephen Slago says PT is the same rules as regular stock. Yes, but there is a way around that, as I mentioned. Jelani Rodriguez is saying, could you revisit the volume open interest that you look for? Yes. So just to restate, if it has 100,000 options, that's generally open interest. That's the minimum amount I want to trade that option for that stock in terms of options for that day. That's the minimum. 500,000, I consider that strong. 1 million options, gangster. Tons of liquidity, great spreads, lots of data points, really robust. That's the minimum open interest that I'm looking for. In terms of volume, if I'm going to day trade, I want that volume to be at least 10% of the total open interest. So if the open interest is 500,000 on that stock, then I want the volume on that day to be at least 50,000. So hopefully I answer your question. Can you close a naked put before expiration? Yes. Any American style option, you can close before expiration. Chrissy is saying, how do you roll over a contract? It's simply closing and then reopening in the same contract at the same strike for different days to expiration. You can roll it into different strikes, different prices, but you're going to pay the difference. But it's basically taking the option and saying, I want to keep this option, but I want to extend it out further into the future. So I'm going to pay for that new option contract while keeping the variables relatively the same. It's 3 and a 5-day period. Okay, copy that. Yeah. 4 round trips or whatever it is. I don't know. I've been above for so long. It's hard for me to even remember that stuff. Chris Gaskins, if I have no intention of holding an option past this week, is there a reason that I would want to choose a further out expiration date? That will depend upon whether you're buying or selling. Maybe there is a difference in implied volatility and premium between the further days to expiration than the shorter. And there's a lot of reasons for that. I don't really have time to go over all the reasons. With a cash account, do they remove the 25K limit? That's a good question. I don't know. It's been so long. I'm pretty sure though, once you get above the 20, no, they don't remove the 25K limit. No. Okay, I got your question. They do not limit whether it's cash account or not. You're still PDT roll. If you're below 25, you're a PDT roll. Lisa, again, in your class, do you suggest certain option trades based on market conditions? Yes. Every single day, before even the market opens, I write a little post to my members and say, hey, look, here's the overall order flow in the options market. We got long gamma, short gamma. There's a lot of short covering this, that. Watch out for this rally. If we're below this level, expect volatility to be heavy. If we're above this level, expect volatility to be subdued. I'm bullish, I'm bearish, that kind of stuff. Yes, we do that every single day. And then during the live classes, when we have open Q&A parts, we go over live trade callouts and everything. Yes. If you're in the money on a long put options, do you have to sell it to make the profit? Yes, or you can close it to a short stock position, and then you would instantly realize the difference based upon the difference in prices. Why roll an option, not sell and buy in others? There's a lot of reasons. There's a lot of individual nuanced reasons. I don't really want to focus on that right now, but there's a lot of different reasons why or why not. Kind of beyond the focus of this class course. What do you look for in VIX? That is a big answer. That is a big answer. You got to think of VIX as it is not just a measure of fear, but it's a measure of risk appetite in the markets. Are they willing to take on more risk, or are they willing to, kind of shed risk? Are traders buying downside protection, or are they selling downside protection? There's a lot of things on VIX. We have an entire lesson just on the VIX in the options bootcamp. I think that's lesson 3, which we're going to go over tomorrow. Understanding volatility, which also covers the VIX. So yes, we have an entire lesson on that. Do we offer trade signals? Yes and no to some degree. Yes, in the sense of like, hey, I'm looking at long straddles, short straddles based upon this, and this. I'm looking at this strike, this kind of expiration. But we don't all like sit there and go, hey, entry, stop loss, take profit, this, and this, and that. That would be a trade signal service, and we'd have to charge you another whatever few $1,000s for that, and we're not charging it. This course is for learning about options, but I do give trade ideas all the time. So yes, and on top of it, members share trade ideas, and then I give feedback on those trade ideas. Somebody says, hey, I'm looking to buy such option, this stock, this strike, this expiry, and now we'll sit there and go, yes, but I would do it like this. I would not do this option. I would do this option. Maybe consider changing the expiration to further out or shorter. Maybe try even this option strategy. I would wait for these strikes and I wouldn't consider in this. So I'm giving that kind of feedback all the time for the members. This has been truly informative. Thank you. I'm glad to hear that, Femi. Do you have in-person classes or is everything online? We do live classes Monday through Thursday. We have different lessons each day. And then Friday, we have open office hours. That's live. The open office hours is really a chance for them to ask any question they want about options and then any call outs. Hey, I'm looking at this trade. What do you think? How would you trade this? And I will tell them exactly. But we kind of save the open Q&A office hours for open questions and then really just analyzing the market in real time and going over trade ideas, their trade ideas, my trade ideas, all that in real time. Besides SPY and Qs, are there a group of ETFs indexes that are good to focus on? Not as much in terms of liquidity. IWMs would obviously be fine. But beyond that, once you start getting outside of that, the liquidity is not the same. Let's see here. If you have a cash account, you can trade as much as you like. You're only limited to the size of your account. Okay, sure. I don't know. I'm on a margin count. I'm above the PDT rule, so it's hard for me to know all that. Okay. All right. Let me go to Stephen says, outstanding detail, Chris. Thank you. You're welcome. Okay. Last question from Sammy's Bozai. And then I have the last slide, and then we can do some open Q questions. Typically, how long would you say it would take to earning back the cost of the option school $12.97 if you're working with a small account? There's no way for me to answer that. I don't know what skill level you have. I don't know how well you learn. I don't know what times of the day you're trading. I don't know how long it's going to take you to digest this and apply it. There's no way for me to answer that. That would be like walking into a martial arts school and saying, hey, how long before I'm like a second level black belt, second dan or something like that? No way to know, especially if they know nothing about you. So there's just too many variables for that, Sammy. I know everybody wants an answer. Hey, it's going to take you 6 months, a year, but there's so many different ways. I don't know how your brain works, how it's wired, learn, memorize, practice, skill, how much time of the day, what times of the day you're trading. It's just so many variables. There's no way for me to answer that. So I wish there was, but I don't have the HAL 9000 AI database to answer these questions. Any one-on-one time available? No, just because, it's not a scalable model for me to do one-on-one. There's only so many hours I have in a day to work. So, yeah. And if I did, I'd probably be charging like $5,000 an hour. It's just not worth it for me and not scalable. Eventually I hit a limit in terms of hours I can work in a day. So I'd rather just work with as many people as I can. Do you teach day trading options or buying out 1 or 2 year options? We teach it all. Day trading, swing trading, long-term trading. We have a whole lesson on just those various types. Tony, 2-part question. Where can I find a list of some stocks that carry day-to-day volatility, helping yet more aligned with selling options? Where can I find a list of some stocks? You would need to create a list. You would need to create kind of filters for that. But to be honest, I think you'd be better off looking at the Benzinga Options Pro app and then using the movers filter to help you isolate your list of stocks that are moving on the day. Eventually we will be creating apps. I've talked with Benzinga about this. We're going to be creating apps just for options. And we'll make that available to course members in the Benzinga option course. But we're going to creating apps for all kinds of things. Hey, here's the stocks that are above their 10% volume and this and that. Like, we're going to create a whole list of apps for that in the future. Yes, leaps as well, Stefan. Do you ever set up option trades pre-market and queue them up? Risky? Yes, but I really, I'm going to be mostly focusing on, once the market opens. Is there any particular times of the day that are better or worse to be buying, selling options? Obviously, the greatest amount of liquidity is going to be in the first 2 hours and then the last hour and a half. especially if you're day trading. But the thing about it is that sometimes, your closes and there's a big move in the markets. So it's really a question of when are things moving the best and when is the pricing there? And some of that you can't control. But if you only have so many hours in the day, trade the first 2 hours or trade the last hour and a half. Those will be your highest liquidity times on a day-by-day basis. Do you think there's some stocks that you should not trade options on, although they have options ability? Yes, any stock that has less than 100,000 open interest. What is the best free screening tool to use to spot potential trades? I don't know. I pay for my screening tools. I know TradingView has some filters that will tell you movers, but that in and of itself isn't going to tell you what are the best trades, because then from there you have to go and to look at the options themselves and see if there's a good opportunity or not. Liquidity equals larger movement in the stock price, not necessarily. SPYs has tremendous liquidity and it barely moves. It's not a huge mover. It has greater liquidity than Tesla, and Tesla is a far bigger mover. So liquidity is not direct. It does not directly mean higher liquidity, does not mean higher movement. It has the capacity for that, but it's not a perfect correlation. What do I use for screeners? I use the Benzinga Option Pro app. That's where I start because I want to look for things that are moving. Newts, you have to talk to them about that. That's Benzinga. We are going to be focusing on day trading and swing trading. So yeah, we have a whole section on day trading and swing trading. And I would probably say the majority of our focus is on day trading and swing trading, because leaps, there's only so many leaps you can make in a year. There's only so much you can make on that. Femi, how much do you use candlestick patterns? I do not use candlestick patterns. And for the record, price action, candlestick patterns, while they do represent price action, I don't think they're effective ways to understand price action. I think there are far superior ways than trading candlestick patterns. Candlestick patterns are limited to 1, 2, 3 bars. The problem is you get great at spotting these 1, 2, 3 bar patterns, but you miss all this other stuff going on. Far better to learn to read all the price action in context, in gestalt, than focusing on 1 or 2, 3 bar patterns. And statistically, candlestick patterns, and the majority of them don't work and don't work that well. Thomas Bukowski demonstrated this. Okay. With that being said, I think I've gotten all the questions. All right. I want to cover the last slide, and then I kind of got to wrap it up because I've been speaking for 2.5 hour class early this morning, hour and a 15-minute class after that. And then this class has been 2 hours. So I've been speaking a lot today. We've talked about the role of the dealers and option makers, market makers in the options market, and that kind of reflexivity. I also want to talk about something called dealer gamma exposure or market gamma. They're slightly different, but relatively the same things. So option dealers are highly active on a daily basis in the markets. I buy 100 SPY calls. They're short 100 SPY calls. They have to immediately hedge that. That's like done almost instantaneously, algorithmically. But that's not the only hedging they do. As time passes, they will start to hedge that position. So that means they're going to start adding or taking certain liquidity out of the market. So that's another type of hedging impact. As volatility increases or decreases, that is another type of hedging activity that they will do. So dealers are constantly hedging throughout the day, and those flows have an impact. That hedging is very mechanical. It's incredibly mechanical and all done algorithmically. And so I've talked about various types of hedging. The moment I make the trade, there's a type of hedge. As time passes, there's a type of hedge. As volatility increases or decreases, that's a type of hedge. As gamma exposure increases or decreases, that's a type of hedge. This hedging activity affects direction and volatility massively, massively. And if you don't understand that, you won't understand why the market is doing what it's doing. Now, what are we looking at here? This is a chart. These little dots have plotted the statistical, the y-axis is how much this has moved. It could be percentage based or point by point based, but basically what it's saying is this 0 represents 0 gamma. What does 0 gamma mean? It means that the market is not net long options or it is net short options. It is 0. So it's neither net long or net short options. All the options in the universe, the market is either net long, net short, or 0. Okay. Now, in this direction, this is positive gamma. It means the market is net long options. You can see that the distribution of price variation is contracted. It's contained. The more positive gamma we get, the smaller the price fluctuations up and down. The closer we get to 0, the greater the price fluctuations, the greater the volatility. What happens when you cross this Rubicon into negative gamma? Volatility expands massively. Now, don't you think that would be important to know on a day-by-day basis if we are in positive or negative gamma? I would think so. I would think that'd be a very important piece of information. We are providing this to our members before the market even opens. I am telling them every single day, hey, we're in positive gamma. We're in negative gamma. We're heavy positive gamma. We're heavy negative gamma. Expect volatility. Don't expect volatility. All this and that. I am telling the members on a daily basis, day by day basis, every single day. So that is a very powerful piece of information. It's important because if you trade and you don't understand, you could be in a situation where the volatility is high and you don't know that. You're expecting a small move. You're going to do mean reversion. The problem is the market might be in negative gamma and it might be expanding massively in volatility. You have the wrong tool and wrong strategy for the wrong environment. If you learn this, then you will start to be able to understand whether you're in a high volatility or low volatility environment. Is mean reversion the best play or is it not? Is it time for me to get long or short options based upon the volatility? Very important. So we are covering this every single day. On top of it, I've talked with the Benzinga team. We are going to be building an app inside the school for members where they will get access to that data. And they'll just be like a once a day report. They'll get the, hey, this is the gamma. Here's how much long, short gamma notional. We are going to build that app. So it's super exciting. I'm just super excited about not just what you're going to be learning in this course, but the apps you're going to be getting access to. To give you an example of a couple environments where we had long or short gamma environments, or long, we were positive gamma, positive gamma here, negative gamma environments. We've been in negative gamma since we had the FOMC. Markets have been negative gamma. Volatility has increased massively. That doesn't mean it's necessarily going down or up. It means that the market will have greater volatility going up and down. Where were some other positive gamma environments? This right here, positive gamma. This right here, negative gamma environment. Very important that you understand what's the weather for the day. If you don't understand that, you're like, as I said in a prior webinar, you are a kite in the wind. You have no idea what the weather is going to be like. You're totally at the mercy of the weather. Instead of that, become a weatherman. Learn how to read this. We are teaching. We have an entire lesson on this. We have an entire lesson on this on market gamma, how to understand it, how to read it, and how to trade it. This is positive gamma. This is negative gamma. This is positive gamma. So sometimes you're ever wondering, God, why isn't it moving? I don't understand. It's just stuck in a range. Now you know. We're in a positive gamma environment. Oh, wow. Why is this thing exploding in volatility? Hey, we're in a negative gamma environment. Imagine knowing that every single day. Imagine looking up in our chat room and being like, okay, I'm in negative gamma. I should expect volatility today. Oh, I'm in positive gamma. We shouldn't expect heavy volatility today. How powerful would that be for your trading? So there is a lot to this. There's a lot more we could have covered. I have only covered the surface of this. I've only had 2 hours to cover a broad range of topics. Hopefully I've been able to explain them in decent detail and answer your questions and give feedback and talk about that. I would like to keep going on, but I have been speaking for like 6.5 hours today. And so I'll take a few more questions and then I'd like to call it a sesh. Can you explain what's after level 2 option trading? I think it's level 3. I don't know, because again, from the day that I started trading options, I was given the highest credentials. So I honestly don't know. But I imagine they allow you to do more and more option strategies, more complex strategies. Should I be rushing to get to level 3? You shouldn't rush. You should get there at a pace that works for you. Michelle D, can you please advise where and what you mean by 100,000 open interest? I've only heard of open interest on the options chain. I've never seen 100,000. 100,000 would mean the total open interest. All the options on that stock in the universe. That's what it means. Total open interest. Shamar Rubin is. Yeah. Okay. Level 3 is more advanced. Yeah. Can I see the gamma on Ford? Yes, I have proprietary apps that help me do that. I'm not allowed to share that with you publicly, but I am able to share that with members and the information. But yes, I can see the gamma on Ford. Last I checked, we are in positive gamma on Ford. Gary says, powerful video, Chris. You are making a difference. Thank you. I appreciate it. Is this positive, negative gamma unique to Benzinga? No, but no, this is positive, negative gamma. I know we are probably one of the only ones teaching it though. But yeah, no, it's not you. Positive, negative gamma is a condition of the options in the market. That's it. If you have the subscriptions and the apps and the data, and you can collate all the data and analyze it, then you can get access to that. But that costs thousands and thousands of dollars to do that. So instead of doing that, we are providing this for our members. I'm providing this in a once a day update. Daniel Davis says, this is awesome. I'm already in the trading school and we'll be joining this class soon. Awesome. Looking forward to having you there. Elon, no, I'm not allowed to show it to you because it's a proprietary app and I'm not allowed to show you that app. I wish I could. Okay, that's the questions there. Will stocks, ETFs with high beta produce more opportunity to trades? Not necessarily. Again, it'll depend upon, volatility. There's a lot of things that'll determine whether it's a good one or not. Why are you not using candlesticks when trading options? Because I feel that candlestick patterns are inefficient and do not enhance your skills that well as a trader of price action order flow. Why is that? If you spend your time learning about 5, 10, 15 candlestick patterns, okay, well, that's time that you're dedicating towards that you're not using towards learning other skills. How many applications can you use of those patterns? There's only so many combinations of those patterns. Those patterns, though, don't teach you how to read the rest of the price action order flow. All they do is say, hey, when you have this 3-bar pattern, do X, Y, Z. They make you very mechanical, and they don't take into gamma, context, positive, negative gamma, open interest, all these other things. And so what it does is it basically means that you get myopic. It's like this soda straw view of what you see. You're like, okay, I see that pattern. I'm going to trade this, but you're missing all the other variables. Far better, in my opinion, is to learn how to read the order flow of all the candles. Instead of focusing on patterns, why not learn the order flow of all the candles? It's a far better skill. Learning candlestick patterns is like saying, I want to be a mixed martial artist in the UFC, but I only want to learn 5 or 10 kicks and punches. Is that effective? No, you need to learn all the kicks and punches for all the different situations. Candlestick patterns are passive skills. When the patterns are not happening, you don't have trade signals. They're passive. Active skills is learning how to read all this context and then applying that in real time to all the different situations. So that's why I don't, whoever asked the question, that's why I don't recommend candlestick patterns, because I find them inefficient, passive skills. I want active skills, not passive skills. Is gamma easier to understand or work with than RSI? I don't find RSI to be that effective. I think gamma is a far superior thing to learn than RSI. What does the term gamma squeeze? So somebody asked this earlier. Let's answer this. Okay, so the term gamma squeeze, I want to give a simple explanation because we haven't gone over gamma. But the thing about it is like this. Remember I talked about that reflexivity of options and the option dealers and market makers? So let's take an example. Let's say a dealer has very little hedging exposure to, say, AMC stock. Okay? Let's call it XYZ stock. Okay, I come in and I buy like 100 calls of this stock. Okay, if the dealer had no exposure to that stock before, that's going to increase their exposure dramatically. If I buy the calls, the dealers are short the calls. So how do they hedge that risk? They have to buy the shares. Okay, so I'm now putting the dealer in a position to help support my trade because they have to buy shares. Now, if 10 or 100 or 1,000 people or 1,000,000 people come in and start buying more and more of these long calls, they are now forcing the dealer into that position of having to buy more shares to hedge that position. Okay, so that starts the process of a gamma squeeze. Now, gamma is a Greek that works for you when you're long and it works against you when you're short. I'd have to explain more about gamma to get more into that explanation. But gamma is kind of is part of what allows a certain convexity to your options. And when that convexity starts to really skyrocket, it forces an increase in buying and selling due to the gamma exposure. That's the short explanation. There's a longer explanation that takes more time. So hopefully that gives you a short explanation. Okay. Is trading SPX the same as trading SPY? No. It's a good question. The reason being, the SPX is generally what the institutionals trade. This is the price on the XPX, 47.13. It's a larger number. It's what most institutions trade when they want to trade the S&P 500 index. The SPY is more for retail. It's cheaper. It's 469 versus 4700. You're going to be able to buy less of the SPX at 4700 than you can buy SPYs at 469. So SPY is generally considered the more retail S&P 500 ETF. And it generally has, sometimes it can have more contracts, sometimes less, but they're not the same. They do both try to represent the S&P 500, but they're slightly different approximations, so to say. Susan Mudiel says, thank you so much for the awesome information. I appreciate you're welcome. Would there be something similar to the ratio of advancers to decliners? Not so much. That's more looking at stocks that are going up and down. It's not quite the same. It's not the same in options. You wouldn't want to equate that to gamma because that isn't going to tell you the gamma exposure per se. So yeah, it's not quite a good approximation. Rodrigo, one word haircut. There's many of us in the Benzinga staff that probably telling Rodrigo he needs a haircut. What is the market effect of the stock when people exercise the options? It depends on the amount of that, the options are being bought or exercised. LG, MR, Grantham, we've already answered that question. Looking at your chart you have exposed, can you briefly explain where you consider a day trading entry? I need to see how it opens. I need to see the overnight data. I need to see how it opens tomorrow. The market's closed right now, so this isn't offering me a day trade because I haven't seen the overnight options data, and I need to see how it trades in the pre-market. So I need more information. Where can I see gamma index for any option? You can't. You have to pay for that access. You have to have an app that processes that information. It's not freely available, made for everybody. Eventually, we will make an app for that for Benzinga Option School members. And then maybe sometime in the future beyond that, you can get in Benzinga Pro, but then you have to pay for it as an add-on type feature. What is the Sizzle Index? That's, I'm pretty sure, exclusive to Thinkorswim. It's really just talking about how hot is the options activity or not. Christina Perez Basura saying, so much info, I have to take the course and watch the playback. Thank you. I caught a lot. I'm glad to hear. Where can I view overnight options trading? You have to see overnight options trading. If you're talking about the overnight day, I don't know if you're talking about overnight or you're talking about the data that's being processed, but OPRA, OPRA, Options Pricing Something Authority, if you sign a contract with them and you pay hundreds, maybe thousands of dollars a month, they will give you an opportunity to then view that data, but then you have to collate it and analyze it. I don't recommend it. It's expensive. That's why we're trying to build apps to make it cheaper for everybody. Okay, I've answered all of the questions. Let's look at my YouTube people. Do we have a fundamentals course? Not that I know of. But again, I gotta be honest, Shamar Rubin Israel. I'm not entirely sure a fundamental course will be that great because of the fact that, again, it doesn't really matter. The fundamentals could say whatever they want. If the flows are pointing in opposite direction and they're dominant, they're going to move it in an opposite direction. The bottom line is fundamentals are subservient to flows. So far better to learn flows than learn one of those individual skills. I don't recommend learning the individual skills first and not understanding flows, because if you don't understand flows, again, you'll be a kite in the wind. You won't know when you're in positive, negative gamma. You won't understand why the market is moving the way it is. Just curious then, how do you plot your entries and exit if you don't look at candlestick patterns? I look at price action in the Gestalt. I look at the options order flow. I look at the overall gamma in the market. I put all those things together and then I come up with a trade idea. I will teach those skills to members of the Benzinga Option School. Elon, on a 1 to 10 scale, how many times does the price hits your target when you trade based on the gamma you see? I haven't measured. I mean, I'm looking at gamma on every single trade. So my accuracy tends to fluctuate between 58 and 63%. I think to start off this year, I've had a slow start this year. Like this is my first or second full week. Last week, yeah, I was not trading that much last week, but so far I've made about 10 trades to start this year. And I think my accuracy so far is like around 70%, but it's still early in the year. My accuracy tends to fluctuate between 58, 63, 64% as a whole. And my average plus R is about 3R per trade. For every $10,000 I'm risking, I tend to make about $30,000 in profit. DNL says, thank you for teaching us from Great Britain. I appreciate it. Okay, I've gotten all the YouTube questions. All the classes are recorded and uploaded to the video library. Yeah, so every class in the Benzinga Option School is recorded and made available to members later. Stephen says, outstanding, Chris. Thank you again. You're welcome. Thanks for attending, Stefan, sorry. Chris, I'd love to. I am spent. I am spent. I had a 2.5 hour class this morning, then I had another hour and quarter class after that. And then this is now almost 2.5 hours. That's like 6.5 hours. Like my voice is starting to go. You can hear it starting to go. I'd love to do more, but I'm kind of running out of time. And so, okay, I'm going to wrap this up. I hope you guys enjoyed this. I hope you got a lot out of this. I hope I was able also to give information to every level of trader, beginning, intermediate, or advanced. We covered a lot of different topics, kind of all over the board. I tried to make them as succinct as possible, but hopefully this gives you an idea of how we're teaching options differently than a lot of the other people out there, and pretty much almost everybody out there. We're not teaching material that's too advanced. We're not teaching material that's too simple. We're covering the whole spectrum, and we're really covering the entire foundation and everything that you would want to need to learn as an options trader. We're covering it all. And so on top of it, I hope this gives you an idea of what it would be like to get 3 hours of live instruction from me on a day-to-day basis. Except the only difference is that we're focused on very specific lessons. And on top of it, all y'all, if you're a member of the Benzinga Option School, you get to ask me live every single day. I'm long this call, I'm short this call, I'm long this option, this, that, whatever. What do you think of it? What's the gamma looking like? What's that? Get that feedback every single day. And then on top of it, have all these other hundreds, if not thousands of members sharing this information. So, I have just given you little sneak peeks into much bigger lessons that we go into the Benzinga Option School. So I hope I get to work with you in the future. I hope you become a member. And other than that, I think we're doing one more class on Thursday and one on Sunday. I'll go over some different topics for each one. Again, little sneak peeks into the whole course. But I really hope you guys learned a lot from this, and that your perspective on options is different than what you came into this lesson with. So with that being said, I'm going to wrap it up. I'm going to take a break, probably have a nice glass of wine. So thanks, Rodrigo, for hosting this. And yeah, I hope you guys enjoyed this, and I will see you guys next time.
Absolutely, Chris. Thanks for being here with us. Appreciate your time. And I know everybody here had a great time. The people in the chat are loving it. I'm going to stay answering questions about the option school and a couple of things that come there, the syllabus here with the folks. Chris, appreciate your time, man. And I'll see you in the school tomorrow.
Sounds good. Good seeing you, everybody. Take care. Thanks for the questions. I'll see you next time.
All right, guys. So I'm going to show you the option school really quick. I'm going to show you that Benzinga Pro as well, and the syllabus. You can tell me what we can watch, but this is the syllabus, and I'll pull it up here, but I just want to go over the sessions really quick before. Okay, so this is the library, the video library. This is where you have everything. This was the class on the left side, Introduction to Options, that we had on Monday. The classes began on Monday. So you guys are starting at a good time for those that join, and you get everything that pretty much was discussed, Benzinga Pro. These are the Q&A sessions. Office hours are on Friday, I believe Chris said. So this is where you'll find them. In the top, you'll see it says Video Library. If you go to the chats on the right side, right there, you'll see that you'll have a chat room where Chris will be posting their trade ideas. We're offering this for a special just today included with the option school. You're going to have a chat room with class files, community support, general discussions, questions for Chris, and student trade ideas. Chris will be pitching in this chat room as well. So you're going to have different resources here that are going to help you, right? Then if you want to go to Pro, this button right here on the far right will take you right there. So you click on it, takes you to Pro. This is just a chart I was looking at a week ago, and it got saved there. I'll post the link for you. Dan, let me put the link in the YouTube chat. 1 second. Yeah, it's until midnight, correct. This deal is until midnight with Benzinga Pro, with the lessons, the courses, the Q&A sessions, office hours. Yeah, this is a chart that I'm showing you guys, but you can see all the tools here that come with Benzinga Pro. So these are all resources that you can use and then bring that back to the trading, to the option school, where you can talk about it with your fellow classmates. This is a great tool. Insiders, you can see basically it'll show you the companies that have the biggest insider buys, or the individual when there's multiple insider buys. I just refreshed it, and you can see it tells you the percentage that they own, the quantity, the price, their title, right? Chief Merchandise Officer, EVP, CEO, and president. So you see who's buying, basically their position and how much they're buying. You have individual insider purchases, the same concept applied to penny stocks that are more volatile. And then you have the insider sales as well. So for both sides, this is just one resource. There's hundreds of things here. You have a calendar here that you can filter it by IPO, analyst ratings, dividends, earnings, economics, calendars, FDA guidance, M&A, everything. You have the only scanner that's open pre-market and aftermarket. So you can basically scan for stocks before your class, after your class, and always as a community work together and help each other. That's how trading becomes more powerful for people, when you have 200, 300 eyeballs looking at a stock and everybody's pitching in and looking at different things that maybe you missed. So this scanner is fully customizable for pre-market, regular hours, or after hours. You can control the time period, 5 minutes, the session itself, a week, a month, 3 months, and you can select the market cap and price and the sector. So you can pick energy, consumer staples, financials, healthcare, whichever one that you want, so that you can find the best trade ideas before anybody else. If nobody has, not a lot of people really do have a pre-market scanner, customizable, or an aftermarket scanner, you having it does give you an advantage over the rest of the people that don't have it, of course. Yeah, Dan, no problem. Lane, I'm posting the link in the chat for the Zoom. The membership is well, the education is ongoing, right? Education is a lifelong process. We never stop learning. The subscription itself is for 1 year, Christina. Stephen, you can send me an email. We don't have it, but I don't know. I might be able to do something or an exception. We'll see. Just give me a ring. I'll put my contact there on the chat. Yeah, Richard, the community is pretty cool. So, all right, this is the scanner. This is just another tool, right? We have a signals tool as well. Let me pull it up. You can see block trades, price spikes, halts, when they unhalt or come back, opening gaps, highs, session highs, day high, 52-week highs. For the lows as well, session lows, day lows, 52-week lows. You can filter this by your watch list as well. So everything I'm showing you, you can filter it by your watch list. The other thing I haven't shown you guys is the news feed. Let me open a new window for it. I'll show you a trick. So this is Benzinga exclusives, right? You open the normal news feed here. It's the first one. You go to categories. You click there where it says exclusives. This is the news that Benzinga breaks. So like Tilray, looks like there was an interview with the CEO of Tilray today. Tuesday, there were like 6 other ones. Yesterday, there were like another 5. So you can see that Benzinga's footprint really is spread out around the stock market in general. These tools, I mean, you guys just have the advantage of being able to get all these tools together. That can give it provides a bigger impact in your trading, that you have these tools that we break. So these are all news that we broke. Benzinga broke this news with these companies. If you have Benzinga Pro, you get this news faster than any other brokerage, because this news goes into other brokerages as well. As you can see on TD Ameritrade, Robinhood, Fidelity, all these other places, they get the news from us and we break the news. As a pro member, you get it like as soon as we hit enter, pretty much. This is one tool, another of the many tools, right? The advanced news feed in general, you can filter it by keywords as well. So for example, here, I'm going to put FDA approval, and you can send email alerts on this as well. FDA approval, you see every PR that has FDA approval in it. So Floyd, this is a one time for the year, so yearly. So FDA approval, you're going to get every single PR that does that. Every PR that comes out with FDA approval, you're the first person to know, right? You don't find out by, and you can even use this. Imagine, so you have this, your pre-market scanner. All these tools are, you don't have to use them all, but use the ones that fit your style of trading. And there's going to be at least 5 or 10 you can use from everything that's here. These are just some of the tools. You have the Squawk radio. So we have a Benzinga radio pretty much. We have a Charlie there. We have one for equities, one for options there. Basically, it's a real life person going. I think it's from 7 a.m. to 7 p.m. around there, literally saying verbally the news that is breaking before it hits the print. So before it even comes out, sometimes in PRs, you're gonna hear it in the radio from Mr. Charlie. This is included. Everything I'm showing you is included. All these tools, guys. Let's see what else I can show you here. All right, so this is the general chart I showed you at the beginning from the details tab, this one right here. So if you go to the overview, you can see here the change in price for regular hours and for after hours. So you get both prices. In the regular overview here, you're going to get the information, key data from the company on the right side. You have a chart there as well that we're including. This is all the news that we gather, we aggregate from hundreds of places worldwide to always give you the best, fastest news that you're not going to see in brokerages. Unfortunately, I've used different brokerages, and there sometimes the stock will be moving 50%, 100%, and there's no news there. And then I go in and check in my Pro, and Pro has like already 6 articles on it that we write, because Benzinga writes a lot of articles as well. And you'll see that we break the news many times. And also when it moves, you're going to see something like this in the top, this blue thing that says, why is it moving? This is actually a department of people that we have here in Benzinga Pro that they gather the news. And as soon as we can match the news and the movement, right, you'll know. So you don't have to go out sometimes and find the news. If you're trying to do a quick trade, we have this, it's all included. It'll tell you why the stock is moving, right? It says affirm shares of several companies in the broader technology sector are trading higher amid a drop in yields, which caused stocks to rebound following recent weakness. So it'll give you the exact reason why either a specific stock or a group of stocks is moving. Yes, absolutely. All these, everything you can see it all inside here, Pro. So this is Pro. This is included. The chat room here as well is included in the trade in the Benzinga option school. You're going to have all these different chat rooms. So this is all going to be separate outside of Benzinga Pro. And I don't know if you guys want to go over the syllabus. We're just going to look at it really quick. Okay, so this is the syllabus, guys. If you need it, just send me an email. I'll send it to you. Let's start from the top here. All right. So these are some of the objectives, and Chris went over a lot of this earlier, but these are the chapters. Okay, guys. Class 1, Introduction to Options. Class 2, Understanding Option Greeks. 3, Understanding Volatility in Options. 4, Single Leg Option Strategies. 5, 2-legged option strategies. 6, 3 and 4-legged option strategies. Class 7, Combining Option Strategies with Price Action. Class number 8, Market Gamma and how to build your own option strategies. There are going to be a lot of other things that will be taught that are obviously not in a chapter that we can't make a full chapter of. Just like today, you guys asked like 500 questions, totally, spread out. Well, you also can do that. Not, whenever you're doing like the Q&A sessions, if you have a question about something, you ask in the Q&A session or in the office hours. That's why those times are there, so that you can ask any questions that you have, either about the lesson or something related to the lesson of sorts, right? So these are all the chapters that you guys are going to see, along with everything else that you'll be learning throughout the classes. All the Q&A sessions will be recorded and uploaded so that all you guys can learn from other people's questions as well. Like, even if somebody attended this session and didn't even ask a question, you learned from every other question that everybody else was asking. So, all right, guys, I'm going to drop the link here one more time. And if you have questions, just reach out. I'm going to leave the link running up here for a little bit. If you have questions, guys, ask it here before we do close the stream, though. So yes, just to recap, you guys will get Benzinga Pro, all the tools that I went over, and really it was just a couple of tools. There are way more things that you can do in Pro. This was just a little quick 10-minute thing. If you do this every day in the morning, you're going to have so many trade ideas just by going over all these things I just went through inside Pro, which is included. So yes, you get all the sessions, you get all the chat rooms. Glenn, send me an email. I'll send you the syllabus. No problem, dude. So you'll get all these chat rooms that are in the option school. That's the student trade idea chat room, the one for Chris, Chris's trade ideas, general discussions, questions for Chris. We have a chat room so that you can ask questions for Chris Capre. So this is hand holding to the max. Okay. Nothing like this existed when I started trading. It would have been great to have a resource like this because there's a lot of misinformation out there, a lot of these TikTok kids, you know, and YouTubers. So having a professional like Chris Capre, someone that's, you know, been there, done it successfully, currently doing it, that's the best kind of instructor. That's the best kind of teacher, a teacher that's actually done it and is doing it successfully. Tazim, send me an email and I'll send you the syllabus. No problem. All right, guys. So that was a quick just a quick show there of the syllabus. I'm going to take it back to the school. All right, let's go to the video library. All right, let's say if you have a 9 to 5 or something like that, or you're busy working or, you know, at school, you always have the lessons recorded and uploaded. So, you know, you're not penalized for not attending class. You can watch it later and you can watch the Q&As and all that stuff. So it's always going to be there if you need it, guys. But, you know, I highly encourage you guys to attend the live class because it's really fun. So with that, guys, I'm going to drop the info here. I'm going to leave the stream running for a bit. If you have questions, just reach out. Thanks for joining us today, guys. Appreciate you being here, taking your education seriously, taking it to the next level with Chris Capre in the option school. So I'll see you guys there. Make sure to join. 7-day money back guarantee. If you don't like it, you get all your money back. That's simple. All right, guys. I'll see you at the next time.